Okay. So all things being equal, by the end of this month, we should be able to finish with the standards. Okay. That is the target now. But if there should be the need, we are going to be doing some of them are done. Okay, so we have to now start with our final account and the ratio. The ratio is not anything, it's just the normal ratio that we do, and how we can also analyze what a financial statement using a budget one. Then we also look at the ratio analysis itself, where we are going to be looking at liquidity ratios. Then we also look at the analysis using budget information. Then we also look at what we call common size analysis. So we'll be doing three another analysis for 20 marks. Okay. It is likely that they might examine you on the ratio analysis because it's a new one, and that's always the best way of interpreting what financial statements. Then we now look at the final accounts. Okay. For the public sector, they have combined all the standards. If it should be financial reporting and corporate reporting, they have divided some of the standards. Some of the standards you're supposed not to do them in financial reporting. But for public sector, they have combined all of them. We need to do the business combination, group accounts, investments in associates. So the 3 months will not be enough for that one. So what we are going to be doing is if there's a need, we'll be doing some of them are done. We have to do borrowing costs because the issue of the National Cathedral can also lead to the issue of borrowing costs because they are going to be what? They are going to be borrowing funds to finance that particular one. So the cathedral will be a qualifying asset. So how do we do, or what do we do about the interest that we are paying on the funds? Okay. Then we also look at impairment of assets. Okay. Then we look at financial assets. We also have leases there. Okay. Like I should have asked you to be joining the dawn class Saturday one for the leases, but we have done two. So if you join right now, it will not be like you'll be seeing only stars. Okay. So we have impairments, we have leases, we have financial instruments. Then we also have the borrowing costs. Then yeah, leases. So at least those three we should be able to finish them. Those four we should be able to finish them. Okay, the rest, employees benefit and those ones. Okay, we just have to come and maybe pick question and try to explain them. Okay, so we just try and see if they can pick the 20 questions from any of them that we are coming to do. But the question will come from your accounting policies, changes in the estimate, and also the correction of errors. Question will come from that particular side for you as a question on a standard. Okay, but we are going to be looking at so we try our best and see if we can actually finish most of them. There are plenty, but we just try to cover the important ones and see what will happen in the exam. Okay, so today we are going to be looking at a very important issue. Yeah, senior, the one is up.
Yes, please, I wanted to find out, will you, for instance, you mentioned that of the lease and the other ones that happens during the dawn sessions. Can you have those videos shared with us so that those that we miss, we can watch?
Yeah, I don't have there's no problem with that. But what happened is that you see, if you come to the public sector class, you can see that those who are doing financial reporting and the public sector, they will testify that the way I see the standard in the financial reporting and the public sector is different. Because public sector assume that maybe this is the first time that we are coming to, or we are hearing about this standard. So I normally take my time to do it. So maybe if we should do it on our own, the understanding, the way I will explain will be different from maybe the way the explanation will be done in the financial reporting class. But nevertheless, I can also share the video with you on time so that we can come back and revisit them again. Okay. So
Okay, thank you.
That is not an issue. All right. Okay, but if you have anyone who is going to be writing ICA exams next sitting, the recommendation to be public sector and financial reporting very necessary. Okay, so that is the issue now. The combination should be public sector and financial reporting. So we are coming to look at a very interesting what? A very interesting standard. Okay, which you can see question or they can give you question because they just pay attention to those activities that are common in the government sector. Okay, those activities that are common in the government sector, they can set question on it. Issue of this particular one, what happened? That haircut issue. Okay, it's an issue under financial instruments. So they can also ask you a question on those ones. Okay, so you just pay attention to those issues uh, that are that are common. Okay, that are common in the what in the public sector. They can set question on it. It's going to be only 4 questions for 20 marks, or maybe three. Some of them will be 6, 7, or 5. It can be any of them. All right. So we are going to be looking at a very interesting standard. We are going to be looking at two at a go. They are not anything. Within 2 hours or 2 hours, 2.5 hours, you'll be able to finish. Okay. We know that basically all governmental what projects are being financed through what? Through the national budget, isn't it? Basically, all government projects, all public projects are being financed through the national budget, through the allocation from national budget. Is that correct?
Yes, sir.
Okay. But are we also aware that the government can also enter into agreement with the private organizations to come and what do certain things on behalf of what? Of the government.
Yeah, that's true.
Okay. So you see, basically, all governmental projects, all public projects are being financed through allocation from the national budget. But the question is, how much will be coming from that side? It's not going to be that much to meet what the government what expectations. So the government can actually also enter into a contract with a private individual to come and carry out certain projects for a certain number of period where they were going to be giving the asset back to the government, or they are going to be retaining the assets. Okay. And that was what we have been looking at as a public-private partnership first. But that has been now been put to what? To financial management. So the government can also, instead of the government constructing a hostel or a hall for University of Ghana, they can actually engage a private individual to now construct the hall and run it for a particular period and hand it over to the government. Okay, that's also a way of raising funds, and they have now sent it to financial management. But there's a very important side of it. Okay, I hope we can remember the PDS. I don't know whether it is PDS, the PDS deal. I hope we can remember the PDS deal.
Yes, sir.
Okay, what was the arrangement? What was the arrangement? The PDS deal, what was the arrangement? Okay. Maybe we have forgotten. We haven't paid attention to that one. Okay. The PDS deal is an example of what we are coming to look at today. Okay. We have certain public services. We have certain public services. Okay. There are services that are very crucial to the public, and that are services that have to be carried out by what? By the states. Okay. The government of Ghana or the public can enter into arrangement with what? With an individual to come and carry out that particular service with the what? With the government's existing asset, or the individual will come with its own asset and what? And carry out that particular what? That particular service. So we know that protecting the what? Protecting the life of what? Of the citizens is what? Is a public service. But the government can now enter into what? Into arrangements with the private forces that will come and protect what? Protect the life and the property of the citizen. That's a public what? That's a public service. Okay, how are we going to do it? Government can say that we already have the what? The tools, we already have the guns, we already have the structures. So what will happen is that just come and what? Just come and deliver the service using our existing assets, or we are going to construct, or we are going to now prepare what? New guns and new cloth and all those things that you are going to be using to what to protect the state. That's a public service. It can also be a transport. A transportation is a public service. It's a service that is what? That is very common to the public. So the government can also enter into an agreement with someone to what? To now a private individual to now what? Carry out transportation service to what? To the public of Ghana. And the PDS is what? Is one of the what? The issue that we are going to be looking at now. What we are coming to look at is PDS deal is part of it, where the government has now asked the PDS to now run what? The supply of what? Electricity using the government existing what? Assets, because they are not going to be bringing their own assets. The government, we have the dam already, everything is set. They're just going to carry out that particular service through the government assets. What we are coming to look at is what we call service concession what arrangement. When do we have what we call service concession? Okay, a service concession is an arrangement where the government will now enter into agreement with what? With a private individual, which we call the operator, to carry out or to provide a public service through what? The use of what? Public assets. Through the use of public assets. So if you are now asking the American forces to now come and protect the life of our citizens in Ghana, either using their own assets or using the existing assets of the government, that is what we call a service concession arrangement. It's going to be for a particular period. Okay, it's going to be for a particular period. So government of Ghana can enter into arrangement that people will now what? The universities. Okay, private individuals will now come and run the universities for what? For the public. Okay, they are going to be using, so government can now enter into agreement that, okay, the way they are running UPSA is not fair. So they are asking private individuals to come and manage that now. Okay, you know that education is a public service. So the individuals now will now come and what? Run the school for a particular period. Okay, they can now put up the structure there and do it for a particular period, or they will use the existing asset to provide a service for a particular period. Why would the government do this? Government normally do this when they find out that, okay, they can no longer what? Provide that particular service, or they don't have the resources to provide that particular service. So the individual will come and run that for a fee. Maybe there can be an arrangement that it will run for 5 years, where the individual will be recouping his investment from the fee that will be charging. Okay, the government can also ask the individual to come and run UPSA for them for 5 years, depending on how the institute is making what consistent loss or whatever is the issue. Okay, just an example. I'm not saying that UPS they are making losses. It's just an example. Okay, so if they are coming, they might be using the existing structures that the school is having. They might be using the existing structures that the school is having, or they'll put up a new structure and run it for a particular period. That's what we call the service concession arrangement. So we are going to be looking at basic what definitions under the concession what service concession arrangements. Okay, we have service concession arrangement itself. This can be described as a public-private partnership that contains an asset as well as service components. It's a binding arrangement between what a grantor and operator, in which the operator uses the what uses the service concession asset to provide a public service on behalf of the grantor for a specific period of time. PDS deal. Okay, they are using assets. What is the asset? The asset is what? Is the dam and those things that we have to supply electricity to the what? To the good people of Ghana. And that is going to be for a particular period. But we realized that was what? The deal was a family deal. Okay. The operator is compensated for each service over the period of the service concession arrangement. So the operator, the government will either pay him, or the government will allow that particular operator to charge a fee to recoup whatever investment that they are making. So if you count to service concession arrangement, there is an asset through which the public service will be delivered. Okay, through which the public service will be delivered. We are talking about service. Okay, we are talking about service, not talking about goods or anything. We are talking about what? Service. Okay, we are talking about service. So if you talk about service concession arrangement, okay, we have two parties. The grantor, who is the government or the public, and then we have the operator, who is the individual. Okay, then we have a public service, which will be delivered by the operator through a public asset or through the use of assets. The asset can be constructed by the government itself, or they can use the existing asset like the UPSA one. They can use the structure to do whatever, or the operator will now construct the asset themselves, or the operator will use their own existing assets. Okay, so And a service concession arrangement, the public entity transfer the right to provide public service through the use of an asset to the private party. So we transfer the public service. We can no longer provide it, or we are providing it and we are not doing it what effectively. We are not doing it what effectively. So the government can actually uh, ask a private individual to come and now toll our road for us. Okay, to come and now do certain things for us. Okay, to come and now do certain things for us, or carry out or offer a public service to the state for a fee. Okay, that's what we call the service arrangements. In a service concession, the asset may either be provided by the operator or the grantor or both. The operator in turn assume an obligation to provide such services, normally in accordance with performance requirements set by what? By the entity. We have also identified that now. Okay. The binding arrangement. What do we call the binding arrangement? A binding arrangement is just a contract that is stating the rights and the terms and conditions that has to what? Has to the terms and conditions that has to guide the arrangement. That is what we call the binding what arrangement. So we cannot just come together and say, oh, Charlie, tomorrow come and take me to work. How much are you going to be taking? You say 20 days. The next day, I will tell you that I haven't told you anything. No, we have an agreement, we have an arrangement, we have an agreement which has been signed. So whatever we are doing, there is what there is a reference to it. Okay, there is an agreement to whatever we are doing. That's what we call the binding what arrangement. We call who is the grantor. The grantor is always the public. Okay, so if you are doing this, the government of Ghana will be the grantor, the person who grant the right to the operator or the individual to carry out the public service through the use of existing assets or constructed assets. That particular person is what we call the grantor. So the grantor is always the public. Okay, so if it's government of Ghana that is doing this on our behalf, then the government of Ghana becomes now the what? The grantor. Okay, the grantor. Okay, so the grantor is the entity that grant the right to use the service concession asset to the what? To the operator, whereas the operator is the entity that uses the service concession asset to provide public service subject to the grantor's control of the asset. What do we call service concession what? Assets? The asset that is being used in the service concession arrangement is what we call a service concession asset. Okay, so if you come to ECG, the ECG is the what? Is the asset. Okay, all the equipment of ECG is the asset that they are using. So they are using the dam, the Akosobo Dam, to provide service for us now. Okay, so the Akosobo Dam and whatever tools that we have that they are using to provide the service, the cars that the ECG is having, all of them can be termed as what? The concession asset. So the asset that is being used to provide the service in a concession arrangement, that's what we call the concession asset. Okay, this is an asset. When do we recognize it? We are going to be looking at that right now. Very simple exercise. So service concession asset is an asset, property, plant, and equipment. It can be intangible. So if you are giving the what? If you are giving UPSA to those people, someone can say that the UPSA is the asset, but the UPSA cannot be the UPSA cannot exist without a structure. Okay, so UPSA cannot exist without the structures. So we say the structures are the service concession asset. It is through those things that the service will be delivered. It is through those structures that we are going to be admitting students. Okay, so the structures can be termed as what? The service concession assets. So the service concession assets it can be property, plant, and equipment. It can be intangible, used to provide service in a service arrangement that is provided by the operator, with the operator construct, develop, acquire from a third party. So the operator itself can provide the assets. The operator can bring its own asset to perform the work or to provide the public service on behalf of the government. So it's just something the government cannot do it. It's not everything that the government can do. And we say that it is almost done better when it is done by the individual. Okay. It is almost done. It is always done better when it is when the individuals are involved than the public. Okay, because the level of motivation is very good and the level of the service is also good. So the government cannot perform certain activities. The government will now ask the private to come and do it. And the private, which is the operator, The operator can provide the asset, the service concession asset. The operator can provide the asset, or they can use their own asset to do that. Okay, if you come to issues of the road construction, mostly those people, they come with their own machines. They come with their own machines, or they acquire their own machines, or they can even hire their machines from what? From a third party. So the asset, the service concession asset, can either be provided by the operator or the grantor. So the grantor can actually construct the asset and use it to what? To provide a service now. Okay. Then we can also talk about the operator can use the existing asset. The asset can either be provided by the grantor, who is the government, and that will be examples of intangible assets that are used for the service concession arrangement. Any intangible assets, it can be ticketing, it can be tracking of even what they are saying right now. They are saying they should audit the EC register. Maybe the government cannot do that, so they can use the private individual to come and do that particular one. So they can even use the software to do whatever they want to do. So software
Yeah.
can be there. Any intangible assets. They can use any intangible assets. So we don't have any, we don't have, okay, these are the intangibles that they can use. No, any intangible assets, as far as that can be used to provide a public service. So softwares can be there. Okay, softwares can be there. And designing, maybe they can even ask them to design some softwares or run the softwares for what? For the public. Oh, so it can be any intangible assets. Are you okay? Okay. Is the asset can be provided by the grantor, which can be an existing asset of the grantor, or an asset that upgrading has been done to that particular asset. We call something a whole life asset. A whole life asset is a service concession asset that is going to be used for what? For its whole life in what? In providing the public service. So what we mean by the whole life asset is that in the service concession arrangement, the asset or the service will be provided for what? For the whole of the asset useful life. So there will not be any residual value for the asset, or there will not be any other years on that particular asset. Okay. So if it is 50 years, the asset is having a 50 years useful life. So we are going to use the asset for 50 years. We are going to provide a service for 50 years, and the asset will be used for 50 years. And after the arrangement, that is the end for the assets. That's what we call the whole life what? Assets. The whole life assets. So as an asset that is used in a service concession arrangement for its entire what? Results. For its entire results. Okay. Most of the service concession, what happened is that after the concession period, okay, after the concession period, the asset will now be transferred to the government to do whatever the government will be doing with it. Okay, so the asset, the service concession asset, will now be transferred to the government. Okay, how do we account for this? And when do we recognize what? When do we recognize an asset? That's what we are coming to look at right now. Okay, when do we recognize the assets? Okay, when do we recognize the assets? If the government is using its existing asset for the service arrangement or for the service concession arrangement, what will happen is that the government have to now reclassify that particular asset. So if the government is now using existing structure, let's say we are using a UPSA, for example. Okay, so the government is having maybe the building of the UPSA as, let's say, 20 billion and 8 financial statements. Okay, and the government is now giving now the UPSA out for service concession arrangement. What government will do now is that the government has to now reclassify the building from property, plant, and equipment to what we call service concession assets. It's a software that the government is giving out. The government have to reclassify that this particular asset is no longer for administrative use. It's now used as a what? As a service concession asset. So what will happen is that the government will now reclassify this at what? At carrying value, because we are giving the asset out at carrying value. So we now have a service concession asset in the statement of financial position, okay, which will be the carrying value of the existing asset that we are giving. What if Okay, what if for this particular one, we know that the government controls this asset, the government controls the asset because it's the asset for the public. So the government will take the asset back again. Okay, the government controls the assets. So the government will take the asset back again after the service arrangement. What if the asset is being constructed? What if the asset is being constructed by the operator? What if the asset is being constructed by the operator? The government should recognize service concession assets. Okay, the government should recognize a service concession assets when the government controls, so they can ask you for the recognition criteria for what? For recognition criteria for a service concession asset. Okay, we have now entered into an agreement. We have now entered into an agreement that you are going to construct a hostel. After constructing the hostel, you are going to give it out or you are going to rent it out for 10 years. After the 10 years, you will now give that particular what? That particular hotel back to me. Okay, what it means is that I can tell you how you should use the assets. So government can control the asset through the usage. Okay, the issue is that the asset or the hostel should be used for only what? Renting to students. You cannot give it out to what? To maybe funeral, those are coming for funeral or those are coming for graduation. No, it will be rented out to what? Only students of University of Ghana. You cannot give it out to students of UPSC or students of what? Jimpa. Okay, in that case, the government controls how the operator is going to be using the assets. So the government should only the grantor, okay, the grantor should only recognize what? The grantor should only recognize an asset, okay, which is a newly constructed asset or asset that is being what? Existing asset of the what? Of the operator. If the government controls that particular asset, the government controls the asset. When do we say you control the asset? You can direct how the asset should be used. The government can tell you the asset we are going to giving out to only students of Legon. No student of what? UPSC should occupy that place. No student of GIMPA should occupy that place. In that case, the government is now telling the operator how that particular asset should be what? Should be used. Okay, so if the government controls the assets, when the government controls the assets, then the government can go ahead to what? To to recognize a concession asset. So government controls the asset either through use or regulate how the asset will be used. The government can now what? Recognize the assets. But the government does not what? Control the assets. Okay, if the government does not control the asset, or the government cannot tell how the asset to be used, but the government can also control the asset through ownership or beneficiary or residual value. What is happening is that at the end of the concession period, we have agreed that the asset will be transferred to the government. So the government will make sure that the asset is in a good condition. You will pay the asset so that the asset will be in good condition, that they can also benefit from the residual value. So we have two ways. The operator, the grantor, can recognize the asset provided by what? By the operator as a service concession asset when the grantor what? Controls the asset or regulates the use of the asset, or when he controls the asset through ownership, beneficiary titles, or otherwise any significant residual interest in the asset. So sometimes the question will be telling you that the residual value of the asset will be transferred to the government after that one. In that case, the government controls the what? The asset through the residual value. So these two conditions should be there for the government to what? To recognize what we call the no place. Assets will not be derecognized from the books of the grantor. The grantor will only reclassify the assets. Okay, the grantor will only reclassify the assets. The grantor is still the legitimate owner of the assets. Okay, so the operator will not claim ownership over the assets. Okay, the operator will not claim ownership over the asset. The operator is only entitled to the revenue that will be coming from what? From the arrangements. The portion that he is going to, the operator is an investor, is an individual. He's only interested in what? In the what? In the profit of the arrangements. So they are doing this for profits. They are doing this for profit. So they are only interested in the return that will be coming from it. The asset still belongs to the government, but they are just using the asset to provide a service. So they are only going to be getting the money that will be coming from the investment. The asset will still be for the government. Okay. the asset will still be for the government, but the government is going to be what? If it's an existing asset, it will no longer be for administrative use. They will now classify it as what? As a concession asset. And we are saying that the asset should only be recognized, the grantor should only recognize the asset when the grantor controls or regulates the use of the asset. When the grantor controls the asset through ownership or beneficiary entitlement and or otherwise any significant residual interest in the asset. Okay, these are the two conditions that should be there before a concession asset can be recognized. They can ask you for the recognition criteria, very simple. The government or the grantor should control or regulate the use of the assets, or if they don't control or regulate the use of the asset, they should be able to control the asset through ownership, beneficiary entitlements, or otherwise any significant one. Okay. If we are talking about the B part, over here, which is the recognition criteria, only refers to those assets that are going to be constructed by the operator, which will be transferred to the government at the end of the construction period. What if it's an asset that is being constructed and that is going to be used for a whole life? If it's going to be used for a whole life, the government is not going to be benefiting for any residual value or any beneficiary entitlement. In that case, the government should only recognize what? The asset when it controls it. The grantor should only recognize the asset when control can be what? Can be exhibited. Okay, in the case of a whole life asset, the grantor shall recognize an asset if the grantor controls or regulate the use of the assets. So if it is an asset that is going to be used for its entire life in the service concession arrangement, there's no residual value that will be transferred to the government. So the second point over there is what? It's not relevant. The grantor shall only recognize the assets when the what? When he or she controls the what? The assets. Okay. If the recognition criteria are met, reclassify assets as what? As a service concession asset. We are talking about existing assets. It's an existing asset, and the recognition criteria are being met. The government will now reclassify the asset. If it's an intangible asset, they will remove it from the intangible asset and now make it now as what? As a concession asset, as a concession asset, as a concession asset in their financial statements. Okay. If they are using existing assets, the existing assets should initially be recognized as what? At the carrying value. It is an existing asset that they are using. If I'm giving you asset that is having a carrying value of 20,000 now, okay, if I'm giving an asset that is the value of 20,000 now, for you to do or for you to carry out a service, I will reclassify this asset from PP to a service concession asset, with the same amount, 20,000, which is the carrying value. But if it is an asset that is being constructed, by the operator, then that particular asset should be recognized at fair value. If you say fair value, we are just talking about a value that the asset can be purchased or the cost of the assets. Okay, that is what we call the fair value. Measurement of service concession asset according to a grantor, according to a grantor accounting, according to section 9 and 10 of the standard, shall initially measure a service concession asset recognized initially at fair value if that is a constructed asset, if the asset is provided by the operator, where the asset is an existing asset of the grantor which was reclassified, it shall be measured at the carrying value in line with what? Ipsas 17 and Ipsas 31. Ipsas 17 is PPE and Ipsas 31 is intangible assets. Subsequent recognition. After the initial recognition, so can the government acquire an asset through a finance lease and contract a private service to operate them? If how do we go about it? It will be seen that the government was operating the asset again, because it is not a private individual that acquired the asset through a lease. So the government will still be paying their leases. They will still have the lease liability in their books, and they will still have the what? The asset. But the asset will no longer be a right of use. It will now be classified as a what? As a service concession asset. So the operator has no what? Has no liability or has no debt obligation to what? To the what? To the arrangement of the lease. He's not going to be incurring any lease liability. What is happening is that he is just performing the service of the government on behalf of the government, which the government is going to be paying him a fee. That is it. So the operator has no liability there. The asset will still be accounted for like how we account it for lease. The government will recognize a right of use and the what? And a lease liability. So the government will be the one that will be paying the renters again. Okay. The government will be the one that will be paying the renters again. It's just like you have been doing the cooking yourself. Okay. You have been doing the cooking yourself. Right now, you have found somebody and the person is doing the cooking for you. It doesn't mean that the person will go and buy his own items before or the person will cook for you. You will be the one that will be buying the what? The cooking items, and the person will just be cooking. The person is doing that on your behalf, and you are going to be paying the person. So it's just like the washing that people have been doing for people for money. Okay, you have been washing the car yourself. Now you want to send it to what? The washing bay. Those people over there, they are only going to wash the car on your behalf, which you are going to be paying them. So if whatever happened to the car, it's none of their business. If you rented a car from somebody and you bring it over there and something happened, it's none of their business. They are only washing the car on your behalf. So that is how it's going to be. The operator has no what? Has no obligation as to the lease. He's just doing that. The government should have been the one doing it, but they don't have the expertise to do it. So they will just give the asset to the what? To the private individual to, okay, we can do this ourselves, but we don't have the expertise to do it. So just do it for a particular period. And if you are doing it, we are going to be paying this amount, or you'll be charging the what? The people that will be benefiting for this particular service that you are rendering. Then you can use that one to what? To sort yourself out. So it is an arrangement which is a lease. The operator has nothing to do over the service concession or subsequent recognition of the asset. The subsequent recognition will be accounted for in line with what? In line with either Ipsas. Okay, it should be Ipsas 17 or Ipsas 31. So if it's an intangible asset, how do we subsequently recognize it? It can be at cost model or revaluation model. So we depreciate or whatever we are going to be doing. So how do we subsequently recognize what? Property, plant, and equipment. It will just be accounted for like that. So we have property, plant, and equipment. It can be carried under cost model or revaluation model. If it's a cost model, then it means that we have to now what? Depreciate the asset over the total useful life with any residual value that we are going to be getting. Okay, so the asset will be used for 10 years. We depreciate it with what? With its residual value. Or the asset will be used for what? The asset is having a remaining useful life of 20 years. But those people are going to be using it for what? For 10 years. What will happen is that we will still charge the depreciation on the asset for the total life of what? 20 years. That's how we are going to be doing it. So if the asset is having a total life of 20 years, but the service arrangements will be only 10 years. No, you can't depreciate the 20,000 over 10 years. The asset still belongs to the government. The government will still depreciate the asset over 20 years. At the end of every year, they will be taking the depreciation to statement of financial performance. Okay, so the subsequent recognition just in line with what? The Ipsas 17 or Ipsas 31, where the government can decide to carry the asset at what? Cost model or a revaluation what? Model. A cost model or a revaluation what? Model. A cost model or a revaluation model. Okay, let's come to this place. Let's come to this place. It's very important that we understand this side of it. Okay, if we have made an agreement that you are going to give me an asset, okay, you are going to give me an asset that I'm going to be using for, okay, let's come here. Let's come here. If we have agreed that, I'm going to construct an asset, okay, I'm going to construct an asset which will be 20 million. Okay, so I'm going to run the asset for 10 years to get my 20 million back. Okay, in the arrangement, before we even start, okay, can I say that since you are going to be recognizing the assets, Can we say that you are owing me 20 million at the time that we are what? We are the asset, the completion of that or the construction of the asset has completed. Can we say that you are owing me 20 million before we even start using the asset? You are owing me 20 million. Okay, let me take that again. Okay. We are saying that I'm going to construct hostels for 20 million Ghana cedis. But I'm going to run this particular hostel. I'm going to run this particular hostel for what? For 10 years to recoup my money. I'm here to start. Can we say that you are owing me 20 million? You, the one that I'm going to be giving the asset to after the period. Can we say that you are owing me 20 million?
No.
The asset is not in my name. The asset is constructed in the name of the state. But I will just, because of the money that I've spent, I'm going to use the asset or I'm going to run it for what? The asset has already been transferred to the state. But because I want to get my 20 million, I'm going to run the asset or operate the asset for 10 years and get my money back. I'm here to operate it based on the arrangement and agreement that we had. Can we say that you are owing me 20 million? I have to get my money before you have the assets. But the asset is not in your name. Can we say that you are owing me 20 million before we start running the assets?
No. Yes, if for instance, okay, let me explain. So if, for instance, the asset has been constructed and you are yet to operate it, then we can say the government is owing you 20 million.
Yes, please. That's what we are saying. We are here to operate it. Okay. So the asset will be transferred to the government. Then the government will now give us the right to operate it for what? For 10 years and get our money. We are here to start operating it. We are here to charge a fee. Can we say the government is owing us 20 million?
No. Yes. For me, yes.
Okay. Okay.
For me, no, because the ownership is still in the hands of the government. And once the
government is not the one that constructed the asset. I constructed the asset with my own money. Okay. The government said that they cannot do it. So I constructed a hostel with my own name. But the government is saying that I have to run it for 10 years to be able to recoup my money. Okay. But I'm here to run it. I'm here to
Then the government is owing you.
Yeah, then certainly the government is owing.
That is very simple. That is how the service concession. So whenever you recognize a service concession asset, you have to recognize a corresponding liability because the asset will be transferred to the government after the concession period. But the government has recognized the assets now. So it's just like the government has to pay for the asset for 10 years because they have the asset. But they have recognized the asset. Or just take it like the operator has sold the asset to the government on credit. Okay, how would the operator get the money? Operator will get the money from operating the assets. But since we are here to operate the asset, it means that at the start or at the time that the asset has been constructed, the government is what? The government is owing us what? The cost of the asset or the value of the asset. Okay, let's take a national cathedral, for instance. Assuming we don't have the money to do it, the government has now what? Asked individual to do it. And the person has spent what? 10 billion on the what? On the assets. Okay, 10 billion on the assets. Okay, but the asset belongs to the government. Okay, the asset is for the government. But the government does not have the money to pay the person outright. So what the government will do is that the government will ask the person to run that particular. So the government will not run that one for the state. The individual will run it for a particular period to get his money. Then the government will now start running it. So it means that the ownership has been transferred to the government, but the money is here to be paid. How will the person get the money? The person will get the money from running the asset for a particular period. Okay. So at the time that you are recognizing, when you recognize a concession asset, a concession liability should also be recognized as as the value of the asset. So if the asset has been constructed as 20 million, the government will recognize a concession asset as 20 million. Okay. The government will recognize a concession asset as 20 million. Then liability should also be recognized as what? As 20 million. Because the people are going to be what? The people are going to be getting this. Okay.
But sorry.
Yes, ma'am.
I think this one will apply when there's a new asset. But if it is an existing asset that is already in control by the government, do we still have to recognize a liability on it?
If it is an existing asset,
Yes.
okay, the only liability that the government will recognize is when the government is obligated to pay any amount to the person.
Okay.
Okay, so that's what we are using when the asset has been constructed. So for existing
Okay.
assets, the only liability that the government can recognize is any amount that the government will be paying to the person themselves. Okay.
Okay.
So if
Okay.
I'm giving the UPSA to you, okay, the person will be charging school fees, but is the government obligated to make any payment to that particular person? And the government will now recognize what? The present value of maybe the amount that they will be paying in the future. So that is the portion of the liability that the government will be recognizing.
Okay.
All right.
Thank you.
Okay, so service concession arrangement that creates service concession assets correspondingly creates service what? Concession liability. How do we go about the liability? Okay. Okay. Generally, the recognition of a service concession asset implies a recognition of a liability. That's what we have explained. Only when an existing asset of the grantor is reclassified as a service concession asset, then the grantor shall not recognize a concession, shall not recognize a concession liability. See, I hope you're okay with that one now. Okay.
Yes.
Okay. How do we measure the concession liability? Basically, concession liability for constructed assets should be recognized the same amount recognized for the concession the concession liability should be the amount recognized for the concession asset. So if the asset was constructed for 20 million, okay, if the asset was constructed for 20 million, then the government should recognize 20 million also as this particular amount. In other words, let me also explain this one like this. In other words, it is assumed that the individual is giving the asset to the government for free. Okay, but the government can only get this particular asset when the individual is able to run the asset for a particular period. So we can also say that, okay, the asset that the individual is giving to the government, okay, the government is not paying anything for it. The government is not paying anything for it. So basically, we can say that the asset that they are giving to the government is equivalent to donation or grant. Can we say that?
So you see, with donations, the government doesn't have to actually give something in return. Here, they are giving them the opportunity to use 10 years to recoup their investment, which could be used by government to work.
That means that the issue with the donation is that there's an obligation that the government, or there's a condition attached to the donation. We look at what we call revenue from non-exchange transaction. Concession arrangement where the asset is constructed can actually be seen as a non-exchange transaction. The asset will be constructed for the state, but this particular asset will become the state owned afterwards, after a particular period. So it means that the person is actually giving 20 million to the state, but this 20 million will be recognized over the concession period. Okay, so this is something that they are giving to the government for free. The government is not going to pay anything unless the government will be paying something for it. Okay, but the person will be taking the money. The person will be taking the money from the citizen, which is not the government. Okay, the government is not paying anything from the public funds, no. But the person will now run this particular asset for a particular period. Okay, I want you to get it better so that we can move on. Okay, it means that the asset has been transferred to the government, but the government can actually start using this asset after 10 years period. So we can see that this is actually a grant given to the government, but this grant will be recognized over 10 years. The asset will become the government owned over 10 years. So if it means that the person have used 1 year out of that particular one, it means that the government can claim ownership for 1 year because it's 10 years. So remaining 9 years. Okay, so someone can also say that this is actually a grant, or this is actually a donation or a non-exchange revenue that will be recognized over 10 years. Because the person has to recognize, or the person has to run the asset for 10 years. So before you can recognize, the 20 million is an asset that is given to you for free. Okay, but you will not claim ownership over the asset now until the person have run the asset for 10 years. So it means that the asset that is given to you for free, that's a donation. But this donation is going to be what? It's going to be consumed over 10 years. So someone can say that, okay, since we are here to start, since the people are here to start with this one, it means that we are going to be having an asset, okay, which will be measured at fair value of 20 million. Then the government will now be having maybe a deferred grant or whatever is the case. So that will be 20 million. Okay. After the people have used 1 year, then it means that we have what? We have realized 1 year of the grant. So we can just divide this one by 10 and we take 2 million to revenue or grant or donation for every period. Okay, that is also another way of looking at it. There's no problem with that one also. Okay, let's move on to that particular.
A quick question.
Yes, yeah.
So with this scenario,
Oh.
can the government recognize this particular asset in its book, in the government book?
Yeah, they can recognize the asset in their book because they control the asset.
If you can go back, it doesn't meet the criteria that we set for ourselves before we can recognize, because we don't control it.
No, the controlling over here means that the government can direct how the asset should be used. And I've set example as what? As the hotel. Okay. The cathedral. In the arrangement, the government is going to be stating how the asset should be used because the asset will become the state-owned after the concession period. So you cannot use the cathedral for what? For any other activities. In the arrangement, the government is going to, okay, this asset, the government is saying that the cathedral will be leased to only Christians. Okay. Excuse my language. The cathedral should not be leased to Muslims or traditionalists. There is no way you are going to be doing that. It means that the government is controlling how the asset should be used in terms of who the asset should be given to. Are you okay?
Yeah, I'm good.
All right. So it's not about you having ownership. If you can control how the asset should be used or regulate how the asset should be used, we say that you are controlling the assets. You are controlling the assets. Yeah.
And also about the fact that at that time of the service concession, there is no economic benefits flowing to the government through that direct asset or that specific asset.
Okay, for service concession arrangement, there is nothing like economic benefits. So you don't see that the government is not using the asset for what? For administrative purposes. So there's no economic condition that will come there. Okay. For service concession asset, the government should control or regulate the use of the asset, and they should also control the asset through ownership or a beneficiary entitlement or what? A significant residual value in the assets. Okay, those are the two criteria. There's no issue like what? Economic benefit, because the government is not using the asset for administrative purposes. Are you okay?
Yeah, thank you, sir.
Okay. Sometimes, what you have to do is that, okay, the question will be telling you that, okay, the government will not be making any payment for this particular asset. The government will not be making any payment for this particular asset. Okay, so it means that the person is going to be getting the money through the use of the assets. The same way, the question can, give me a minute. All right. So I was saying that sometimes the question can tell you that, okay, the asset has been constructed. So the service concession asset can be constructed at 100 million. Okay. Then the question will be telling you that, okay, the person is going to be using the asset for, let's say, 10 years to get what? To get 80 million out of it. Then the question will be telling you that the government will make payment to these particular people for the remaining one. The government will now make payment to these particular people for the remaining one. Okay. it means that the government will be paying 20 million, isn't it?
Yes.
Okay.
Yes, sir.
So it means that what will happen? Asset of what? 100 million has been given to the government for 20 million. You can see that the 80 million portion of it will be treated as what? Revenue from non-exchange transaction. I don't know whether you are getting the link now.
Yes.
Okay.
Mhm.
So you are getting the link now, isn't it? Okay.
Yes.
But this
Yes.
particular 80 million cannot be recognized immediately. Okay, this particular 80 million cannot be recognized immediately because the person is going to be using the asset for 10 years. So the 80 million should also be recognized over what? Over 10 years. Okay, the government will also pay this amount over 10 years. So what will happen is that if you are recognizing a concession asset of 100 million, this is what you are going to be doing. Okay, then you have a liability. The liability will now be, it's not this one, the government is not paying anything, but that is the portion of the what? The grants, the portion of the non-exchange transaction that is going to be recognized over 10 years. I hope you're okay with that one now. Okay. So we take it as what? We take it as a liability because we are here to recognize that particular amount. Someone can say deferred revenue or an end revenue. Then the liability itself, which is a cash portion, will also come there. So we can say this is the portion of the non-exchange transaction, or let's see, this is the amount of the government will be paying 20 million. Okay, this is how you do it. After the year has ended, this is what will happen. What is the revenue that has been generated by those people? What is the revenue that has been generated by those people? If they are able to receive 20 million, the government will also recognize the 20 million as a portion of the what? The non-exchange transaction that will be taken to profit or loss. Then the government will make equal payments over what? Over the 10 years for 20 million. So every year the government will be paying cash of what? Cash of 20 million. So this is what we do. Okay. So what you do is that you debit your liability. Okay. The people have now realized 20 million. So the government will also recognize this 20 million as revenue. So we have 20 million there. Then we count to the amount that the government is paying. That amount will still be reducing the liability. Government will now be owing them 18 million. So 2 million will be taken away. Okay. Then you come over, you credit your cash. You credit your cash of the amount that the government is paying. Then you now credit your revenue item, or maybe any revenue at all. Okay, grant or donation or whatever is the case. Okay. So you credit the revenue item with the what? With a portion so the recognition of the non-exchange transaction will be based on the amount that the people are receiving every year. So the people receive 20 million, the government will also recognize 20 million as what? As that particular portion of the what? Non-exchange transaction that has been realized. So this is how we go about it. A very simple exercise. Okay. A very simple.
So,
yes, yeah.
so sir, if the government decides to pay the 20 million at once, are we going to bring in time value of money here?
No, for this one, if the government decides to do this one, unless the question is asking you to take into consideration time value of money and they are giving you other issues over there. But if they are giving you discount rates and those things, then it means that the government will be paying the 20 million, the government will be paying it at the end of every year. So you can actually find the present value of all the payments. Then you treat the difference as what? As a finance cost. That can be possible. Okay, but if you're not giving any issue about discount factor, then you just treat every year, you treat 2 million as what? As a difference. But if you are giving a discount factor, it means the government will be paying 2 million every year for 10 years. So at the end of every year, government will pay 2 million. At the end of every year, government will pay million. We can assume that as a rational being, someone cannot be owing you 20 million today and you'll be expecting the person to pay the same 20 million in the future. It means that this 20 million the government will be paying over the 10 years, the person has now factored in what? Time value of money. So what will be the cash price of this amount that the government will be what? Will be recognizing? What will be the cash price of this amount that the government will be recognizing? Or what is the price? What is the cash price of this amount that the government is owing the person? We now bring that particular one, then we now calculate the interest on it as a finance cost, at the end of every year. But since we are, okay, for the public sector, I don't think the issue will come like how it will come in financial reporting. But if you are given that, that's no problem. And the standard also make provision for those issues of time value of money. Okay, so let's,
Thank you, sir.
all right, now. So let's move on with this particular one. Okay, so let's move on with this particular one. So we are saying that when it is an existing asset, no liability can be recognized because the asset is owned by the government. Okay, the asset is owned by the government, so the government will only receive maybe sometime the operator will even be paying part of the revenue to the government. It can be a share revenue. Okay, sometimes government will also have a portion of what of the share revenue. Measurement of a concession liability. Okay, initially measured at the amount as a service concession, which is a fair value adjusted by the any other consideration. Example, cash from the grantor to the operator or from the operator to the grantor. Okay, so the liability that we are having, sometimes the grantor will be paying some amount of money to the individual. Okay, so what will happen? That is the portion that we have done now. You can see the liability was 100 million, but the government will be paying what? 20 million out of it. Whenever the money is being paid, then the government will now go and reduce the liability. Okay, there can also be a situation where the operator will be paying to the grantor. So what will happen is that the government is owing them this amount, and they are also going to be paying the government this amount. So we can do net off. Okay, we can also do a net off for that particular amount. So I'm owing you 200 million, and you have to pay me what? You have to pay me 10 million out of that amount. It means that I can ask you to take the 10 million from the 200 million, then you'll be having 190. And that is what they are actually talking about over there. Let's come to the measurements or the models of recognition of liabilities. We have two models. We have the financial liability model. Okay, this is a place where what we have spoken about, where we have the time value of money, it is mostly applicable under this financial liability model. The financial liability model applies when the government has a cash obligation, or has an unconditional obligation to pay cash or another asset to the operator for the construction, development, acquisition, or upgrade of a service concession asset. What do we mean? The amount that the government is going to be paying does not depend on any condition. Does not depend that if the operator is not able to generate the expected revenue, the government is going to be paying a certain amount to compensate them. In that particular case, the government can only recognize the liability based on the probability of the people not getting the revenue. But for the financial liability model, the government has unconditional obligation to pay cash or another financial asset to the operator. Whatever happened, the government is going to be paying that amount. And that is the first one that we have looked at. Okay, if you have the issue of time value of money, then you can actually calculate the present value of all the cash flows and be increasing it by the finance charge. The payment due from the grantor to the operator shall be separately accounted for as a reduction in the liability recognized, a finance charge, and a charge for service provided by the operator. Okay, the finance charge and charges for service provided by the operator in a service concession arrangement shall be accounted for as an expense. So if we present value the 2 million the government will be paying every year, if we present value it, there will be a difference between the 20 million and the amount that we are getting today. The difference in that particular amount will be a finance charge that will be recognized over the period. That will be the one that they are saying the finance charge. The operator can actually provide additional service to the government, which the government will be paying for it. As far as or as soon as those services are being provided, the government will pay for it and recognize them as operating expenses. Okay, as operating expenses. The finance, okay, I've spoken about that one. So the financial liability model applies when the government has unconditional obligation to pay cash or another assets for the construction, development, acquisition, upgrade, or service concession arrangement. That is the example that I've given, that the person is going to be realizing 80 million from using the asset, but the government is going to be paying 20 million. That 20 million is not based on any condition. For that part, in that particular case, the government will now account for the portion that they are going to be paying as what? As a liability, which we call the financial liability model. So what they will do is that it's just like how we use the amortized cost. You find the present value, you find the present value. At the end of every year, you'll be what? You'll be unwinding your what? You'll be amortizing your what? Your cost to get your finance charge that will be taken to profit or loss. So this will be treated like how we treat a lease payment. We have the present value, which is a lease liability. We charge the interest on it. Then we subtract the amount that has been paid. Then we carry the what? The closing balance to the statement of financial position as the what? As the lease liability. That is what we are looking at under this particular situation. Okay. Let's come to grant of right to operator model. Grant of right to the operator model. This one comes in when the government does not have what? Any unconditional obligation to pay cash. The government will only pay cash based on certain issues. Okay. What will happen is that the government can actually give Bank of Ghana. Okay, the government can give Bank of Ghana to what? To an individual to run the banking for, let's say, 10 years. Okay. The individual will just be looking at maybe the operating system. They will just be controlling the operating system. The workers over there will still be what? Will still be the public workers. Okay. Now you are giving all the premises of Bank of Ghana to those people. Now the people have to utilize all those places. But there's a place that the public workers are still parking their car. It means that that particular place cannot be used by the operator. So if the operator should have used that place, what will be the revenue that will be getting? Since the government officials are now occupying that place, government will pay what? A cash relating to the portion of that part, the revenue relating to the portion that has been occupied by the government officials. That's why we use the grant of right to the operator model. Recognize the liability as the unearned portion of the revenue arising from the exchange of assets between the grantor and what? And the operator. So that is the example that I've given now. The government of Ghana hospital or the 37 hospital has been given out to a private individual to operate it for 10 years. But still we have public workers over there. If we are giving that particular place to those people, it means that we are giving all the premises to them. They have to utilize all the premises. Okay. Now they have to mount their canopies and what? Check people for this one. But now government officials are now parking cars at some areas, so they cannot actually what? Mount the canopies there and carry certain operations that are going to be giving the revenue. Okay, if the canopy should have been mounted at those areas that the cars have been parked, what would have been the revenue? Okay, since that particular place has been occupied by public officials now, it means that revenue related to that portion will not be earned. So the government have to now what? Reimburse those people with the revenue that would have been earned if that particular space has been utilized. So the government will only recognize the liability relating to the portion of the revenue that has not been recognized during that particular arrangement. That is what we call the grant of right to operator model. Okay, so the government recognize or the operator recognize the liability as the unearned portion of the revenue. What are we saying? That is the example that I've given. Because of the car space over there, that area cannot be used. So that area will not be used for generating what? Revenue. The governments have to now reimburse them from that particular what? Unearned revenue. It is applicable. The grantor does not have an conditional obligation to pay cash or another asset to the operator for the construction, development, the upgrading of a service concession asset. So the government will only pay this amount if revenue for that particular portion has not been earned. So if you go to work today, the public officials, have they parked car there? If yes, the government will pay. If no cars has been parked there and that place has been utilized, government will not pay any revenue. Government will not pay anything to those people. Okay. So the grant operator the right to earn revenue from third-party users or another revenue generating what? Asset. Okay. That is what we call the financial liability model and the grant of right to operator model. Financial liability model comes in when the government has unconditional obligation to pay cash or another financial asset to the operator for the construction, development, acquisition, or upgrade of a service concession asset. Okay, in this case, the government can recognize any finance charge or by recognizing, let's say, the present value of the amount, or they can say the government will be paying, the government is supposed to be paying 20 million, or the government will pay the 20 million, which will be subjected to an interest of 5% every year. So it means that the 20 million the government will pay now, but the government don't have the money to pay. So they want to pay, let's say, in 2 years' time. It means that you have to be charging the interest for that 2 years or whatever amount that you are going to be looking for. The question will state that for you. Okay, let's come to dividing the arrangements. Okay, let's come to dividing the arrangement. What do you mean by dividing the arrangement? Okay, what do we say by, or what do we mean by dividing the arrangement? When a grantor compensates the operator partly by making payments and partly by the grant of right to the operator, the portion of the total liability should be accounted for what? Separately. Okay, so what will happen is that the government, okay, that is the example that I've done first. Okay, Senior Fred, looking at this, you can say that is the example that I've done first. Government is paying 20 million and the 80 million relate to what? To the portion of the what? Of the non-exchange transaction. Okay, that's what they are saying. If the government is paying a certain amount of money, the amount of the government is paying should be treated as a separate liability, and the non-exchange what? The revenue arising from non-exchange transaction should also be treated separately as what? As a separate liability. That's what they are saying. Okay, the amount initially recognized for the total liability is the same as the fair value of the concession asset. That's the typical example of the first one that I have done. Okay, that is a typical example of the first one I have done. Okay, the grantor is required to account for each part of the liability according to section 18, paragraph. Don't worry about that one. The standards, the ones that I've shared with you, you can see that we all have 1, 2, 3, 3. So those are the paragraph and those ones. Okay, so if you have one, that is paragraph 1. So if they are quoting those ones, they are just saying that if you go to the normal standard, the full standard, the 26, the point 26 over there, that is the paragraph 26 that they are talking about. Okay, so that one also have section and whatever is the issue over here. Recognition of other revenues. Recognition of other revenues. Recognition of other revenues. Okay, any revenue that will be arising for a service concession arrangement in accordance with what? The Ipsas 9. So they can be like the government will do something to the operator, and the operator will pay the government for that particular one. Or the government will not give the assets, and the operator will pay a certain amount of money that they are receiving from that one. What it means is that the government is giving you assets, you are paying something for using that particular asset. So the government can only recognize the revenue when the asset has been utilized. Okay, to be recognized in line with what? Ipsas 9, which is revenue from what? Exchange transaction. We have standards. So we have revenue from exchange transactions. We have 31. We have leases. We have impairments. We have financial assets, at least 5. Okay, no problem. Let's see. Okay, the operator may compensate the grantor for access to the service concession asset by providing a grantor with a series of what? Predetermined inflows of resources. So there can be other revenue that will be that will be coming from the arrangement. Okay, there can be other revenue. Any other revenue that will be coming over there should be accounted for as as necessary, or how it should be done. Upfront payment or stream payment. There can also be certain payment that will be made by the operator to this one. Revenue sharing provisions. So the revenue that we are generating will be sharing it. There can be arrangement that is going to be given a rise to other revenues. You should be able to check whether that particular revenue has been realized before we move on. A typical example, the service concession, a typical example is the mining issues. Okay, where the government will now be engaging those people. The people are going to be paying royalties, and the people are also going to be paying renters. You see, there's a name given to it. It's been a long time that I've done the advanced taxation. The last time that I studied advanced taxation was 2021. So I've forgotten those things. As far as advanced taxation is concerned, I've forgotten those things. So we have this concession. The concession is always about these mining people that the government of Ghana will call the Chinese people to come and do. They are going to pay royalties to the states. They are also going to pay what we call renters or surface something. Okay, and the government will be having some additional right, or I've forgotten those things. Okay, the law is not written by any of my family people, so It's for the exams, I have forgotten. Okay. They can ask you for the disclosures, very important. Okay. So if you come to service concession arrangements, what are the things that what the grantor has to disclose? Disclose means that you are going to put it in your note. Okay, disclosure doesn't mean you are going to put these things in the face or on the face of the financial statement. You are only going to be talking about these things in your notes. The first one is the description of the arrangement. Okay, the arrangement is about how is the nature of the arrangement. Okay, the description of the arrangement. The arrangement we have now entered into a service concession arrangement with the what? With this particular company to carry out this particular service for this particular period. Just as the description, give us a brief what? A brief info about the what? About the arrangement. The significant terms of the arrangement that may affect the amount, timing, or certainty of cash flows. Do we have any terms over there that is going to affect how the money should be distributed, how payment should be made, or how the activity should be carried out? Okay, the nature and extent, looking at the quantity, the time period, the amount as appropriate. So you also talk about that one. Okay, so the nature, you have the right to use specified assets, right to expect the operator to provide service, specified service in relation to the service concession arrangement. Service concession arrangement recognized during the reporting period, including existing assets of the grantor reclassified as this one. So if any asset has been reclassified, you should state that, okay, during the year, intangible with this amount has been reclassified as what? As a service concession what? Assets. Renewal and termination options. We have anything over there. If there's do we have any clause over there that is stating that if a party to the arrangement violate maybe a term, there will be a termination or there will be a renewal after the concession period? Is there anything over there? If there's something over there, you have to what? You have to also disclose that one. Other rights and obligations, major overhaul of the service concession assets. Is there any issue that we are going to be carrying a major overhaul over the what? Over that particular asset? We have obligation to provide the operator with access to service concession assets or other revenue generating assets. If there's any obligation like that to provide the operator with a service concession asset or other generating assets, you have to also have to what? State that in your notes. Changes in the arrangement occurring during the reporting period. Did we make any amendment to the what? To the arrangement? Did we make any arrangement as to the reducing the concession period or whatever? That must also be what? That must also be disclosed in the disclosure. They can ask you about 2 or 3. So you should be able to keep at least 3 in your head. Okay, or 4. A description of the arrangements. Okay. Renewal and termination what? Options. Okay. Then you also have the service concession asset recognized during the year, including any reclassification of existing assets of the operator. Is there any change in the what? In the arrangement occurring during the reporting period? At least those 3 should be in your head. A description of the arrangement, termination and renewal options, any significant changes in the arrangement during the reporting period, service concession asset recognized during the reporting period, or any existing asset reclassified by the operator as a what? As a service concession asset. You should be able to have those ones in your head. Let's look at the question number 1, which is actually talking about calculation relating to the service concession arrangement. Senior Charles, are you there? Auntie Bennett.
Hey.
Yeah, Auntie Bennett, can you hear me?
Yes, please.
Okay, take that example for us.
Okay. Question 1. Government of Ghana entered into the following contracts in order to meet one of the party promises to the state citizens. A. The government entered into an agreement with Japan Limited to build and equip the state general hospital through PPP arrangements at a cost of 2 billion Ghana cedis in a year 2016. The project was completed and commissioned during the year. The contractor is to operate the hospital for a period of 20 years and thereafter hand over to the government. The contractor is to recover fully his investment through medical fees from patients. From available information, a total of 250,000 Ghana cedis, 250 million Ghana cedis was realized by the contractor from patients in 2017. B. The government so entered into a service concession agreement with a Chinese construction company to construct a 15 kilometers ring road on behalf of the government in 2015. The road was constructed and commissioned in the year 2016. The terms of the agreement were as follows. 1. Cost of the road project, 980 million Ghana cedis. 2. The Chinese company to collect toll fees for a period of years, estimated at 650 million Ghana cedis. 3. The government to pay the contractor a sum of 450 million Ghana cedis within 10 years on equal annual installments. And 4. The difference between the cost of the project and total revenue accruable to the contractor to be treated as return on investment. At the end of the year 2017, end of the year 2017, the contract was able to collect a total of 100 million Ghana cedis as toll fees. The government was also able to fulfill its own part of the agreement required. Explain which weapons operations how the above transaction should be accounted for. Show extracts in the financial statements at 31 December 2017.
All right, thank you. It seems like your network is very bad, but we have managed it. Okay. So these are the two issues. The B, they are saying that the government entered into agreement with Japo Limited to build and equip the State General Hospital through what PPP arrangement at a cost of 2 billion in year 2017. The project was completed and commissioned during the year. So we are saying 2016 and we are saying, it should be 2017. Okay, it should be 2017. So the project was completed and commissioned during the year. The contractor is to operate the hospital for a period of 20 years and thereafter hand over to the government. Okay. The contractor is to recover fully his investment through medical fees from patients. From available information, a total of 250 million was realized by the contractor from patients in 2017. So let's assume that everything happened in 2017. Okay, I should have edited the date. Okay, it should have been 2016, 2017, 2017. Okay, the first part, what will happen? Is the government using existing assets? Is the grantor using existing assets? The first part. The A.
No. It's a French.
Okay, so what will be the issue over there? Okay, a service concession arrangement gives rise to what? So they are saying that you should explain how this will be accounted for. So this should be accounted for under the provisions of what? Ipsas 32 service concession arrangements. Okay, a service concession arrangement will always give rise to what? A service concession asset that will be recognized by the grantor either through a new developed asset or a reclassified asset. If it's a new developed asset, it's going to also create a service concession liability. Okay, then you just say that the grantor shall recognize a service concession asset when he or she controls or regulate the use of the asset or controls through through entitlement or through ownership or a significant residual value in the assets. Okay, you can see that they say that at the end of the 20 years, the assets will be handed over to what?
The government.
To the government. So you can say the government is going to be having a residual value over the what? Over the hospital. Okay. This is an arrangement between the government and the operator. The operator cannot be what? Cannot be bringing what? Cannot say he's not going to be what? He's not going to be operating. He's not going to be operating what? The hospital for Ghanaians. Okay. The government can be the one operating it, but the revenue from that particular period, the government will not touch that particular revenue. So the government can actually send the public workers over there. But the money that will be coming over there will be what? Will be collected by the individual for 20 years. Are you okay? Okay.
Yeah.
So this is the contractor. It doesn't mean the contractor will be the one that will be operating this one. The government can send workers over there where the government will be paying them. But any amount of money that will be coming over there from the patient will be given to the contractor for what? For 20 years. So in this case, we can say the government is going to control how the asset should be used, and the government also has a significant residual value in the what? In the project. So the government will recognize a service concession asset to the value of what?
$2 billion.
Okay, so initial recognition will be, okay, debit a concession asset, service concession asset. So we debit service concession assets. Okay, service concession asset to the value of 2 billion, isn't it? Okay. What will happen? What will be the corresponding entry?
Credit service concession liability.
Okay, so we have service concession liability. Okay, service concession liability. Okay, service concession liability of the same amount, isn't it?
Yes.
Okay. So this one, they have not given us the total useful life of what? Of the building, so you cannot depreciate. After the 20 years, the government will still be operating a hospital. So you can't say the useful life of a hospital is what? It's going to be 20 years. So you don't have anything with what? Depreciation. But they give you the total useful life of that particular one. Then the government can now depreciate the what? The hospital over the total. But they say after 20 years, the hospital will be handed over to the government. So it means that after the 20 years, the hospital will be run for a particular number of years again. So they have to give the total useful life of the hospital in total. But if that is not given, then we assume that the hospital is going to have an indefinite useful life. So no consumption over there. Okay, let's look at the subsequent. Let's look at the subsequent measurements. Since we don't have any information about the useful life of that particular one, then so since we don't have any information over there, okay, did the contractor receive any revenue in the year?
Yes.
Okay.
Yes, sir.
So how do we account for this particular revenue that has been received? Okay. Can we say the government received the revenue and pay it to the contractor?
I think it will.
Hello, sir.
Yes, please.
So I think the liability will be reduced by the 2.
Okay.
I think the liability will reduce by the 250.
Okay. So we debit our liability of what?
250.
Okay, that will be 250 million, isn't it?
Yes, sir.
Yes, sir.
Okay. What will be the corresponding entry? What will be the corresponding entry? Okay, so we credit revenue. Okay, so we credit revenue of the sale amount, which is 250,000. Okay, so they say we should show extract for the A. Let's come to statement of financial performance. Okay, the statement of financial performance. We have, let's say the revenue, we can classify the revenue to be grants or donation or anything. Okay, so that will be, let's say we are keeping 3 zeros at the top, or we are writing this in million. Let's just say we are writing it in million. So this will be million at the top here. So that will be 250 million, isn't it? Okay, let's come to statement of financial position. Okay, so we have the statement of financial position. We are going to be having our non-current assets here. Okay, our non-current asset will be service concession what? Service concession.
Service concession assets.
Okay, that will be how much? We are keeping the figures in million. Would that be 2,000?
Yes,
Yes,
yeah.
sir.
Yeah.
Okay. Then we count to non-current what? Liability. Okay.
Non-current liability, which will be down.
Okay. So non-current liability, we have service concession.
Then we amortize 250.
Okay.
Okay, so you need to show you 1 year. I didn't know anything about.
Service concession. Like, please, this is a very important area for public sector. So they can actually give you a theory question on this one, or maybe a practical question. Okay.
Yeah.
So we will be having 2,000 minus what? 250. Is that correct?
Yes, sir.
So we'll be having 17 what?
Yeah.
50. I hope you're okay with that one, isn't it? Okay.
Yes, sir.
You are going to do the second one for me. So I will just monitor you do the second one. You tell me what we are going to be doing. Okay. The government so entered into a service concession agreement with a Chinese construction company to
Hello,
construct.
sir.
Yes, yeah.
Yes, sir.
Sorry. Forgive me. My network, dropped. By way of a recap, could you please, go over the other one briefly for me?
Well, let me just show you the entries. Maybe looking at the entries, you might.
The subsequent measurements.
Okay, the subsequent measurement, we debit the liability. So the people have received 250 million out of the money. So it means that the amount that we are owing them now will be reducing, or we are recognizing 250 million of the what? Of the revenue from our exchange transaction. Let me just put it like that. Okay. Since 250 million has been paid to the people, it means that we can also realize what? 250 million of that particular revenue. So we have to recognize a revenue of 2 billion over what? Because they are giving the thing to us for free. The government is not paying. It is the public that is paying. So it means that they are giving the asset to the government for free. Okay. They are giving the asset to the government for free. So, but this one, the people have to now realize their money, or they have to take their money over 10 years before they will not be taking any money again. So we can also say that the revenue from the non-exchange transaction will be recognized over 10 years. So since we have paid them 250, it means that we're also going to be saying that 250 has been recognized out of the what? Out of the 2 billion. So we reduce the revenue that we have over there by reducing it by 2.5 and recognize what? We reduce the liability, which is the non-exchange what? Revenue that will be recognized over 10 years. Then we recognize revenue of the portion that those people have been received. So we debit the liability, we credit the revenue. If you count to the statement of financial performance, then this will be seen as grant or donation, or you can also see service concession revenue. Then we have 250 million as part of the revenue. If you count to our statement of financial position, we are going to be having a service concession asset to be 2 billion. The question has not given us the total useful life of the hospital, so you can't depreciate. The 20 years over there is just for the time that what the operator will recognize the revenue for the concession. But that is not the total useful life of what? Of the hospital. So if you are giving the total useful life of the hospital, then you can actually depreciate it. Okay. Then we come to the non-current liability. We have the 2 billion as the initial amount. We have recognized 250 million out of it, and we have 1750 as the new amount now. So I hope all is well now.
Perfect.
Okay.
Thank you very much, sir.
You're welcome, sir. So let's come to the B. I'm saying that the B part, you are going to do the B part for me. Okay. So the government should enter into a service concession arrangement with the Chinese construction company to construct a 50 kilogram ring road on behalf of the government in 2015. The road was constructed and commissioned. Was on behalf of the government in 2016. The road was constructed and commissioned in 2017. The terms of the agreement were as follows. The cost of the road project is 980 million. The Chinese company to collect tolls fees for a period of 10 years, estimated at what? 650 million. Okay. The government to pay the contractor the sum of 450 million within 10 years on equal annual installment, and the difference between the cost of the project and the total revenue accruable to the contractors to be treated as return on investment. So what is the total amount that the contractor will be receiving?
650,000.
Plus the government one. The government will also paying 450.
If you add the two, you have
1,000.
1.1.
Okay. So there will be a difference of 120, isn't it?
Yes.
Okay. The difference they are just telling you that you should treat it as well return on investment for the people. So that is a profit that they are getting on the investment. That's why they are saying that the difference between the cost of the project and the total revenue accrual to the contractor to be treated as return on the investment to the contractor. Okay. What are we going to be having? What will be the concession assets?
The concession assets will be 980.
Okay. The concession asset will be 980. What will happen? Concession liability at that date will also be what?
980.
Okay. That will be 980. Okay. So, but the concession liability should not be 980. The total should not be 980.
No.
Let's separate. Okay.
It's supposed to be 110.
No, it will not be total. The difference over there is the return. But we are going to recognize 980 and 980, but the government will be paying 450 out of that.
Exactly.
Okay. So the concession liability for the exchange transaction itself is 530. For the non-exchange transaction is 550. 530 rather, isn't it? So this will be so let me just do the two. Let's break that. Let's have the B over here. So we debit concession. Okay, we debit service concession assets. Okay, service concession assets of 980 million.
980.
Okay. Then we credit the cash obligation. You can make it cash obligation, isn't it?
Yes.
Okay.
That's 450.
To be 450. To be 450 million.
And then service concession liability.
Okay. So we can debit we credit the service concession liability now.
530.
530. So the two will give you now the 980. Okay. So this is what you do. So this is the initial recognition now. Okay. But this one, since we are learning, that is why we are doing the initial recognition. In the if there's asked you to explain, you can say that, okay, the government should recognize at the time that the asset has been constructed, at the date of or at the starting of the arrangement, okay, at the starting of the operation of the service concession arrangement, the government should recognize a concession asset of 980 and also recognize a cash obligation of 450 and service concession liability of 530 in 8 books. Okay. Then you said at the end of the year, what will happen? At the end of the year, what will happen? At the end of the year, we haven't given any time period for the route. So the road, we see that the road is what? The road is having indefinite what? A useful life. Okay. At the end of the 2019, the contractor was able to collect a total sum of 100 million as toll fees. The government was also able to fulfill its part of what? The agreement. So what will happen? The service concession asset will reduce by what? The service concession asset part will reduce by the 530 will reduce by what?
The service concession liability
Yeah, the liability will reduce by what?
by 100.
So I was mentioning
When you
assets.
said the asset, I was confused.
Sorry, don't worry. It's the weather. So let's move on. So we debit. So my people were silent. I said, how come? Things that we are doing. Meanwhile, I was the one making a mistake. Okay. So we debit the service concession liability with 100 million, isn't it?
Yes, sir.
Okay. Then we also debit the cash obligation, which is a liability, with how much? The government is paying this over 10 years. So every year, what are they
10
going
years.
to pay? They say it should be done on equal installments.
I think it's 65.
No, the government is paying 450 within 10 years on equal
sorry.
advance. Would that be 45?
That's 45.
Yeah, 45.
Okay. So let's pass. In the exam, if they ask you this, you don't be doing the debit, okay? Or you can do the debit and I explain that, okay, the concession liability will reduce by 100 million, which is the amount received, and the cash obligation will also reduce by 45 million. Okay, then let's come here. What will be the corresponding entries? The first one will be credit, cash, or bank, isn't it?
Yes.
Right, sir.
Okay, cash or bank will be what?
The
45.
45.
The 45. Then we credit revenue,
Revenue from non-exchange contracts.
which will be 100 million, isn't it?
Right,
Yes,
sir.
sir.
Okay. So let's come to our statement of financial performance. Our statement of financial performance will be, we have the revenue, which can be, you can classify it. The question will be telling you that it should be classified as grant or other income or anything. That will be 100 million now, isn't it?
Yes, sir.
Yeah.
So our statement of financial position, we have the service concession assets as a non-current asset. So we have service concession of how much? 980 million, isn't it?
980. Yes, sir.
Okay. So our non-current liability, we have the cash liability or the cash obligation. That is a liability over there. That will now be 450 minus what? 45.
That's 405.
405. Then we come to the service concession liability.
That's 100.
No, that will be 430.
That would be the
That's 530 minus 100.
100. 530 minus 100. That will be 430.
530.
How is okay? We have
Yes, sir.
530, so we are reducing
Sure.
it by 100. Okay. So this is the calculation side. It's a very simple exercise. Okay. But if it should be existing assets, there will not be any what? If it's an existing asset, there will not be what?
Service concession liability.
Okay.
Yeah.
And there will not be any what? There will not be any revenue also from what? No exchange transaction. Okay. Because the people are not going to be handing over any asset to you. Okay. But what will happen is the people might be paying you a fee. Okay. The people, since you are going to be using your assets, there will be a revenue sharing arrangement because we are using our assets. Okay, so if we are using our asset, there's no way you should be getting the money if you are using your own assets. So it's because they are building the asset with their own money, giving it to us for free. That's why we are giving all the revenue to them. Now, if you should be using my assets, what will happen is that we are going to share the money that you are getting. We are going to share the money that you are getting, or the government might even be paying them for the service. In that case, the government will be recognizing the expense for whatever amount that they are paying them. Okay, so this is how we go about the calculation side. It's a very simple exercise. Let's take some of the theory one now. It is likely that they will ask you what it is a theory that they have been asking in the previous in the previous syllabus. It is a theory that they have been asking. Okay, so let's look at the example there. The 2. Okay.
Okay, so question number 2.
Yeah.
Discuss each of the elements of the financial statements listed below are recognized and measured under Ipsas 32. Service concession, then grantor. A, service concession asset. B, liability. And C, revenue.
Okay. So let's come there. So they are saying that we should discuss the elements listed below. Discuss how each of the elements of financial statement listed below are recognized and measured under what? Under the Ipsas 32 service concession, which is a grantor. Okay. The first one. Service concession assets. When do we recognize it?
When there exists the service concession contract.
No place.
Okay.
When do we recognize a service concession asset?
When the government has a control.
Don't be using the government. The government is being replaced with the name grantor.
Grantor.
Okay. So when the grantor controls or regulate the use of the asset, isn't it?
Yeah.
Okay. So the standard states that the Ipsas 32 states that a grantor should recognize what a service concession asset when or if these two conditions has been met. The first one is that the grantor controls or regulate the use of the assets. Okay, but don't go and be explaining anything. Just write that one and go. Okay.
Okay.
They will give you 5 marks for what? What explanation again? 5 marks for 3 points, and you want to explain again. It seems like you have all the time in the world. Okay, so the Ipsas 32 service concession arrangement, which we call a grantor. Okay, this is only about a grantor accounting. So it's talking about only the grantor accounting, not the operator accounting. Okay, so the Ipsas 32 states that a grantor shall only recognize what a service concession assets when these two conditions exist, or when these two conditions are met. The first one is that a grantor controls or regulate the use of the assets, or the grantor controls the assets through ownership, beneficiary entitlement, or a significant residual value in the asset. That is it. Okay. Service concession assets arising from asset provided by what? By the operator, or asset constructed by the operator, or asset developed, or service concession asset arising from a constructed asset. Okay, that should be the English. Should be initially measured at what? Fair value. Was an asset, service concession asset, which is what? Existing asset to the grantor, should be measured at the carrying value of that particular asset. Okay, will be reclassified to a service concession asset, which will be measured at what? At a carrying value. Okay, which will be measured at a carrying value. So that is the initial measurement. Subsequent one, it should be measured in line with what? Ipsas 17 and Ipsas 31, which the grantor can elate any of elate any of them, either the cost model or revaluation model. That is it. Okay, that is it. A service concession asset arising from a constructed asset will give rise to what? A service concession liability. Okay, and the liability should initially be measured at what? At the same value of the what? Of the concession asset, which is the fair value. Okay, which is the fair value. And this can be, okay, they are not talking about any of the model. So it should be measured at what? At the initial value of the what? Of the constructed service concession asset. Please don't go and be talking about the liability, the financial liability model and the grant of right to the what? To the operator model. No, those ones, they are not really talking about that one. Okay, they are not talking about that one. But if you have the time, you can see that the grantor can use or can recognize liability under the financial liability model, where he or she has a right to do that particular one. But the liability will only recognize liability when a service concession asset from a constructed asset is being recognized. We always recognize the liability at a fair value. What about the revenue? Revenue arising from this one should be recognized in line with what? Ipsas 9, revenue from exchange what? Transactions. Revenue from exchange transactions. Okay, and this should be measured at what? At fair value, the money that they are paying to you. If there is any shared revenue, what are we getting from the shared revenue? That should be the amount. Very simple. It's a very simple exercise. Okay, it's a very simple exercise, and you don't have to really do much to. Okay, this is a very important one here. This is how they are going to be asking the question. They can ask you. This is a very important area as far as public sector is concerned. Okay, this is common in the public sector. Borrowing is common in the public sector. Okay, so there are certain of these standards there. They can give it to you as a standard on their own. Okay, we have the Ipsas 32. Just take down for us. The question number 3. Then we take the question number 4.
All right. Ipsas 32, service concession arrangements. Grantor establishes the accounting and reporting requirements for the grantor in a service concession arrangement. In these kind of arrangements, the grantor is a public sector entity. Service concession arrangements in the public sector are characterized by binding agreements that involve private sector participation in the development, financing, operation, and/or maintenance of assets used to provide public services. Ipsas 32 intention is to create symmetry with RIC 12, service concession arrangements on relevant accounting issues, that is, liabilities, revenues, and expenses from the grantor's point of view. Require: A. State and explain 2 conditions that a grantor can recognize service concession assets, and B. Explain any 3 information that a grantor shall present and disclose in its financial statements.
Okay. Please, from the old syllabus, it is the Ipsas 32 and the Ipsas 3 that they have been examining. So now, if they say they should examine this one, it means that the Ipsas 32 and the 3 is a very technical point that will be coming. So we have to pay attention to these ones. Okay, just pay attention to whatever we are doing. For the inventory, the revenue from exchange transaction, the PP and those ones, they are for final accounts. If they set question on it as a standard on it, want to find, there's no problem with that. Okay, the exchange rate, okay, Ipsas 4, that is also for the final accounts, because the government cannot have a final. Government cannot carry out its operations without borrowing. Okay, so without borrowing in the external issues. So let's come here. State and explain 2 conditions that a grantor can recognize service concession assets. The conditions.
Hello.
Yes, please. Please, can you hear her? Because I cannot hear her.
One of the conditions recognized service assets is if the
This is my network or your own?
I can hear you, Jess.
Okay.
I think it's my network. Maybe Charles could read.
Yeah, Auntie Esther, can you? I hope your
I
network
said
is. Yeah.
one of the conditions that a grantor can recognize the service concession asset is if the grantor controls the use of the assets.
Okay. Please, this is going to be for the first two is going to be for 2 marks. Okay, these 2 points are for 5 marks. The first one is 2. The first one is 3. If you see the state and explain there, senior, don't go and be explaining how the control you are going to be talking about control. Okay, if you want to explain it to, you can say it's a small way. When the grantor controls or what that regulate the use of the assets, he can control the asset by directing how the asset should be used or what the asset should be used for. Very simple. You are good to go. The next one is what?
Explain three information that the grantor
No,
shall
we have
present
done
and
only one.
disclose.
We state only one
Okay.
criteria. Okay.
When the grantor controls the asset through beneficial entitlement, ownership, etc.
Or a significant residual value in the asset. Please, that one there, you can see that the accounting for the 32, there's no plenty things over there. So if you have a question over there, you should not even give any chance to the mark there. At least you have to grab all of them. Okay. Just the third one. The B.
So the information that the grantor shall present and disclose in the financial statements.
Okay. Okay, so let's what will be the information that will be disclosed? The disclosure.
The description of the
arrangement.
Yeah, of the arrangement, yeah.
Okay, it's a very important. We'll look for the simple ones. Okay.
Renewal and termination options.
Okay. If there's any renewal and termination options should be disclosed. Okay. Under the Ipsas 32, the grantor shall disclose the following one. The grantor shall present and disclose the following information.
This one, they will chew down.
In each financial statement. So the description of the arrangement, okay, termination and what? Any renewal options, any significant what? Changes made in the arrangement during the reporting period. Then we also have any service concession asset recognized during the reporting period or any existing asset or a grantor reclassified as a service concession asset during the year. You can also have the extent and nature as to the specified assets classified. You can just pick 3 or 4 of them. At least should be 4. They cannot ask you more than 4. Okay, you should not give any chance to that one. This is an area.
It's time frame, not part of it. Time frame.
Okay,
that should be like the nature and the extent of the contract.
Let's make reference to that one. Okay, I don't want to tell you something that is not part here. Then you should.
The description of the arrangement.
Significant
terms of the arrangement that may affect the amount, timing, and certainty of future cash flows.
Okay.
The nature and extent. Example.
Okay. Okay. So the time will be part. Okay. The time for the arrangement will be part. So if you say the time frame, there is no issue with that. Okay. Just try to. You don't have to memorize or you don't have to state the point the way they are. Okay. You just have to say something to mean what they are actually saying. Okay. Let's come here. You can say the condition and this one is still the same. Okay, these are past questions that I've taken. So it means that the conditions and then the disclosures are something that they normally ask. So you can see that that is 2. That is a 2-1. But the only thing that they're asking you for service concession assets. A service concession asset. What is a service concession asset? Charles, what is a service concession asset?
Okay, so sir, it's that asset that is either provided that is used within the service concession arrangement and is provided by the operator or the grantor, and it is used in the duration of the contract.
Okay. So a service concession asset is that asset that is used in the service concession arrangement. It can either be provided by the what? By the operator or the grantor. And which in most cases, the residual value will be transferred to what? To the grantor. I say in most cases, it can happen that the asset will be a whole life asset. So that's why you're saying that in most cases. Okay, so you don't have to be very certain about what the asset will be transferred to what? To the grantor. If we have a whole life asset, how do we go about it? That is a very different what issue. Please, let's come here. If you are talking about the conditions that the grantor can recognize a concession or asset, talk about a whole life asset also. You see that the one that we are talking about is only the what? The constructed asset. Okay. So you can also add that in the case of a whole life asset, the grantor shall only recognize what? An asset when he or she controls that particular asset. Okay. So you can also add the recognition criteria for the whole life asset on that particular one. Let's pick the fifth one. Let's pick the fifth one. Then
All right, sir.
we'll see what we can do. Okay. So that we
So
can.
question number 5.
Yeah.
Explain the following models of recognition of liability under a service concession arrangement under Ipsas 32, service concession grantor. A, financial liability model, and B, grant of rights to operator model.
Okay. So how do we go about this one? The financial liability model. Okay, financial liability model. Financial liability model. When do we recognize liability under the financial liability model?
So I can say that for the financial liability model, that's when we see that there is this payments to be made by the public entity. And then the grant of rights to operator model is when we don't see any cash payments or whatsoever, but we see an exchange of an asset between the entities.
Okay.
Okay, so I think the key word when it comes to the financial liability model is unconditional. The grantor has unconditional
Obligation.
Obligation, yes, obligation to make cash payment or something.
Okay. Okay. So
Yeah,
for
that's right.
the financial liability model, what we do is that we recognize the liability. Okay. We recognize liability based on the what? Based on the obligation that the grantor has to what? To pay a particular cash or to pay a cash or transfer another asset to the what? To the operator in what? In the development or construction of what? A construction asset. So this for the liability model, you can just write what we know about the liability model. Okay, liability model, we recognize the liability when the grantor has unconditional obligation to pay cash or another financial asset to the operator in what? In construction or development or upgrading of what? A service concession asset. So the liability that will be recognized will be the portion of that cash, or the amount of that cash that the grantor is going to be paying to the operator. Okay, there can be any finance charges arising from this one. Okay, any finance charges or any fees for what? For services services rendered to what? To the grantor will be recognized in the what? As an expense in the statement of financial performance for the grantor. So you can only say that we recognize liability when the what? When the grantor has an unconditional obligation to what? To pay cash or transfer another financial asset to the what? To the operator in a development or construction or upgrading of what? Of a construction asset. So it's just like what? It's just like a debt, how we classify a debt instrument. Okay, so we say that if you have a cash obligation, to pay a certain amount, that will be classified as what? As a liability or debt instrument if you count to financial instruments. So it's just following the what? The issue of the what? Of the debt component. But for the grant of rights, okay, the grant of right to the operator, it's used when there is no unconditional obligation to what? To pay cash to what? To the operator for development of anything. Okay, the grantor only recognize what? A liability to the end portion of the revenue. That is what? That is arising from the concession what? Arrangements. Okay, so if you are not giving the assets, okay, what is the portion of the revenue that has not been earned based on our arrangements? The grantor will now reinvest or compensate what the operator with that particular revenue. So you only recognize that particular revenue as a liability because that is the amount that you are going to be paying to the operator. So that is it. So you just say those two, and that is fine now. And this would be like, let's say 2.5, 2.5. So 2.5, you don't have to write simple like that and move on. At least 3 or 4 or 5 lines will be okay. Okay, whatever you know about it, please just pour it over there and go. They will sort it out and mark. Okay, whatever you know
Yes, sir.
about the financial liability and then the grant or right model. Sometimes the only way to convince the examiner is to write maybe small, write small, like write plenty small. Okay, he will see whatever the sense that he's looking for, he will see it in the writing. But if you are not sure, don't write simple. Okay, if you are not sure, don't write. You can only write maybe in a simple text when you are sure of what you are writing. But if you're not sure, please write write in as much as you can to convince him to see the reason for awarding you the mark. But you don't have to waste time. You know that you are using time, so you don't have to waste time for any other things that you are going to be doing. So this is basically about the service concession arrangements. Okay, they will ask you for the recognition of the assets. Maybe they can give you a practical question like the one that we have solved. They can give you theory question, which in most cases will be a theory question for you. Then they will ask you for the recognition criteria of a service concession assets, the liability, the disclosure, and also this financial liability model and the grant of right to the grantor model. Those are the things that they are going to be asking you. Okay, let's try to see if we can also look at another issue about about the government or the public sector entities, which we call the Ipsas 24. Okay, the presentation of budget information in financial statement. This one we have been doing it because those, if you check the past question, you see that sometimes they will give you a budget information that you should prepare a budget statement together with the final account. It's because of the Ipsas 24. So this one we are not going to be looking at any calculation. We just be looking at definitions. Maybe they can only ask you to explain the following terms in as used in Ipsas 24. Okay. This will also be, we use the Ipsas 24 should also do financial statement analysis, where you analyze the budget information of the entity. You find the difference between the amounts. They can give you something like the budget out 10. Okay, you calculate the variances and now explain what would be the cause of those variances and how they should investigate them. Okay, so this one we are talking about this one to ensure compliance with the approved budget. Okay, so the question will ask you, why should we include a budget information in the financial statement? We have looked at that one the last time, where we say that it is actually it actually shows a compliance with the budget. Also is improve what we call comparability and all those things. They can also ask you those questions. It's not a big deal. Okay, so we are just going to be looking at the theory part of it, the definition and other issues, and move on. Okay, so the government will be, we know that the government cannot operate without without the national budget, without the approved budget. So if the budget is being approved now and you have spent, okay, it is better for us to attach, for us to be able to compare, to make a better analysis of the performance of the government. The government is supposed to include or prepare the statement together with the budget information. What is the revenue that you want to generate, and what is the revenue that has been generated? What happened? We have to check and see whether you are spending according to your budget, or your budget is a reliable one. Okay, we say a budget is they can ask you for a reliable budget. Okay, we say budget is reliable when a budget has achieved at least 98% of its targets. So if you are saying that you are going to be spending 20,000 on what? On cost of goods, on goods and services, and you have spent 19,000. Okay, the budget is reliable. Sometimes people can actually overspend. Maybe we don't have to spend it, but they will spend because if you are underspending, you are saying that maybe your budget is not reliable. We cannot depend on the budget because the budget is not meeting the target. So people will actually overspend to ensure the reliability of the budget. Okay. So let's come to the definitions that we have in this one. We are only going to be looking at definitions and other issues. The first one is the accounting basis. Accounting basis can be any of the basis when a transaction should be recognized. So the assumptions that we use to recognize a transaction in the financial statement. So that can be the accrual basis or the cash basis. We have looked at that. That's what we call the accounting basis. Okay. We have the annual budget. Annual budget. The annual budget is just a budget that has been approved for the year. Okay. It's a budget that has been approved for 1 year. That's what we call the annual budget. Okay. So if the Minister of Finance sends our national budget to the Parliament and the budget has been approved, the budget will be approved for only 1 year. Okay. And that particular budget is what we call the annual budget. It will be used for only 1 year. That's what we call the annual budget. So annual budget means an approved budget for 1 year. It does not include published forward estimates or projections for period beyond the budget period. It does not take into consideration something that will happen in 2 years' time. No, it is the estimate for only this year. So anything that will happen outside this year will not be captured in that particular one. All the things that we want to do, all the revenue that we want to generate in this year, all the expenditure that we want to incur for the year will be what will be included in the what? In the annual budget. So the approved budget for just a year is what we call the annual budget. The approved budget for just a year is what we call the annual budget. Let's come to appropriation. Appropriation, we know the appropriation. Okay. The appropriation is the authorization granted by a legislative body to allocate funds for purposes specified by the legislature or the similar authority. So when the budget is being given out like that, the Parliament will now publish, or the Parliament will now pass what we call appropriation bill. Appropriation bill is just something like a go-ahead given to you to spend. So appropriation bill is always issued in respect of the expenditure in the budget. So the Parliament will pass appropriation bill. Appropriation bill is just something giving you the power to go ahead to spend. Okay, that is the appropriation bill. So the appropriation is an authorization granted by legislative body, which will always be, we know that for the legislation is the Parliament. Okay, the Parliament is the legislation to allocate funds for purposes specified by legislature or the similar authority. So they will make appropriation. Appropriation will go to sinking fund. Whatever the law is saying that must be specified. So we are looking at disbursement to district assembly common fund. So the Parliament will now pass appropriation bill for those amount of money to be distributed or appropriated to the various districts that we have in Ghana. Okay. We also have the approved budget. The approved budget. Okay. The approved budget. The approved budget is the budget that has been approved by the Parliament. The budget that we are going to be spending. Okay, the budget that we are going to be using for that particular year. The budget that we are going to be using to incur expenditure. The budget that we are going to be using to generate revenue. That's what we call the approved budget. So the budget approved by the Parliament is what we call the approved budget. Okay, and the Parliament will approve expenditure budget by passing what we call appropriation bill, and they will approve a revenue budget by passing what we call a finance bill. So they can ask you the difference between the two. Okay, finance bill is passed for what? For generation of revenue. For generation of revenue. But the appropriation bill is passed for what? For distribution or incurring of expenditure. Approved budget means the expenditure authority derived from laws, appropriation bills, or government ordinances and other decisions related to anticipated revenue or received for the budget period. So the approved budget is the budget that is going to be implemented. Approved budget is the budget that is going to be implemented. Okay, so the Minister of Finance can bring a lot of issues, but all of them will not be approved. Some of them will be rejected. But those that are being given a go ahead are what we call the approved items, and that will give you the approved budget. So the budget that is being agreed on, okay, the budget has been agreed on by the parliament that the government will be using for a year or the ensuing year is what we call the approved budget. Okay, we also have what we call the budgetary basis. Okay, budgetary basis. The budgetary basis means the accrual or the cash or other basis of accounting adopted in the budget that has been approved by legislative body. So what is the method? Okay, on what basis was the budget prepared? The budget has been approved. On what basis are we preparing the budget? That's what we call the budgetary basis. So are we preparing the budget on cash basis? The budget that has been approved. Okay, the method or the basis that is being used to prepare the approved budget is what we call the budgetary basis. So the budget has been approved. Is it prepared on what? Accrual basis or cash basis? Or is prepared on appropriation? Or is prepared on what? On fund basis? Okay, the method used is what we call the budgetary what? Basis. The budgetary basis. Okay, the comparable basis means that we are going to be comparing. So we prepare a budget and see actual and the what? So you'll be having the annual budget. So you see like annual budget or the approved budget. So annual budget is the same as the approved budget. So you have the annual budget, then you have the actual. Okay, then you put the figures there and have the variances. So you'll be having some items over here, like let's say revenue, or let's see IGF. Okay, IGF, then you'll be seeing 20,000 over here. Then you will see, let's say 25,000 over here. Then you'll be having a difference of 5,000. Okay, so this is what you doing a budget like this. That's what we call the comparable basis. Okay, that's what we call the comparable basis. You are preparing a budget so that you can compare the actual result with what? With the budgeted results. Okay, that's what we call the comparable basis. Comparable basis means that the actual amount presented on the same accounting basis, same classification basis for the same entities and for the same period as the approved what? Budget. As the approved what? Budget. That's what we call the comparable basis. The comparable basis. What do we call the what? What do we call the final budget? The final budget is the budget itself plus any supplementary issues during the year. That's what we call the final budget. So we have prepared a budget. We have prepared a budget for the period, and we have realized that okay, so the budget for, let's see, goods and services was 30,000. Okay, so we have realized that no, this amount was not actually the best estimate. So what we are doing over here is that we are preparing a supplementary budget for 5,000. So if we add these two, that will give you the final budget. 35,000 is the final budget. So the actual budget that has been used for the year or approved for the year is what we call the final budget. So final budget is the original budget adjusted for all reserves, carry over amounts.
Yes, my actual plan is that.
Okay, the final budget is the original budget adjusted for all reserves, carry over amount, transfers, allocation, supplementary appropriations, other authorized legislative or similar authority changes applicable to the budget or whatever is going to be happening. So all the changes that we have to do to our original budget after our original budget has been adjusted to take into consideration all the necessary things that should be taken into consideration, then what we have is what we call the final budget. So the final budget. So the budget can also be. Is someone talking to me?
Yes, a question.
All right.
Please, after all these adjustments and all that, hasn't time been spent for that same final budget we are trying to finalize?
It depends, because the budget, if you're preparing a budget, all these things will be taken into consideration. The only thing that you are going to be doing is the supplementary budget, which we don't know what is going to be happening. So supplementary budget, we only do that when the actual budget is what? When the annual budget or the approved budget is in action. Okay. But if you're preparing the budget, what will happen is that there can be some unfulfilled commitments from from the previous year. Okay, so if the ministries are preparing their budget, they are going to factor in these things into the what? Into the budget. So those unfulfilled commitments from the previous year will be factored in before the actual expenses that will be done. Okay, so all those adjustments will be done at the preparation level. Okay, all those adjustments will be done at the preparation level. Okay, so all the deductions and those things, all those things will be taken into consideration at the what? At the preparation level. There can be certain amount that are here to be spent. Okay, so if you are given a allocation of 100,000, you are able to spend only 80,000. It means that you have certain amount that you carry over. So if you are preparing the budget, you prepare the budget for the year and subtract the reserve that you have. Okay, that will also be, all these things will be done at the what? At the preparation level. The only thing that will come in as another issue is the what? Is a supplementary what? Budget. Is a supplementary budget. Okay, we have what we call the multi-year budget, a budget that is prepared for a number of years. Okay, the budget can be prepared for 5 years. So a budget that is being approved, so they can prepare. Those days they have been using the MTEF or something. I don't know. I've forgotten the name. They have been using that particular where budget to be prepared now for, let's say, 5 years. So what they will do is that they will be rolling over the budget. Okay, if the first year, so they will prepare the budget and the parliament will approve it for the 5 years. So it means that they will not come back for debate on that particular budget again. Okay, they will not come as to debate on the approval of that particular budget again. What they will do is that as the first year has been spent, then they will take the first year off, or they will come to parliament to do maybe a budget review or whatever for every year. But the debate on the approval of the budget will not be done again. But they can bring in supplementary budget. Okay, so the budget will be a single budget is going to be prepared for more than a year, and that is going to be having what? Having that is going to be having what? So many issues. So they will just approve it in one what? In one debate for maybe 2 years or 3 years, or maybe 15 months, or maybe 18 months, or whatever be the case. Okay, but they will come for that issue of what? Media review. They will come because they have to monitor how the budget is being spent, so that if there's any issue, they can stop the budget from implementing that one, asking the people to spend before they will come back. Okay, so this one, if it is for 2 years, the budget will only cover 2 years. You cannot include expenditure that will be in 3 years. No, budget is being prepared for a particular period. So something that is going to happen maybe in 3 years' time, wait till if you get there, then you include it. What is the thing that you are going to be what? Incurring in this particular year? Those are the things that will be included in the what? In the budget. What do we call original budget? The original budget is the original approved budget. No issue of what? Supplementary issues. Okay, so the budget that has been approved from the beginning of the year, that's what we call the original budget. So the question will be giving you original budget, then they will give you supplementary budget. So sometimes they can give you, if they want to examine you, they will give you original budget. The original budget is the budget that has been first submitted to what? To the parliament for approval. So it's just a budget from the start. No supplementary has been added. So if you want to get your final budget, come and add your supplementary budget to that one. That will be the actual budget for the period. Then you compare with what? With the actual budget and see whether there is any differences or whatever is the issue there. So we'll be looking at example, and you'll be looking at those issues about the budget. Okay. So we are going to be taking some of them one by one also. Let's come to the approved budget. An approved budget reflects the anticipated revenue or receipts expected to arise in the IU or the multi-period or whatever they are going to be talking about. So the budget that has been approved by the parliament is what we call the approved budget. Okay, approved budget. Let's come to original and the final what? Budget. Okay, original and the what? And the final budget. So the original budget may include residual appropriated amounts automatically carried over from prior year period by prior years by what? By law. So sometimes you see that some of the monies will be appropriated to what? To the ministries or the department, but they will not be able to spend all. Okay, they will say that those monies should be what? should be sent back to the chest. It should send back to the consolidated fund. But sometimes there can be unfulfilled commitments for that particular year. Then they can write to what? They can write to the minister. The minister will now give them a revote warrant. So what will happen is that those things that they are here to do will still be included in the budget. Okay, but just that allocation has been done to them because they have money already for those ones. So they will carry over those balances that they have to spend for those projects to this year now. Okay, for example, governmentary budgetary process in some jurisdictions include a legal provision that requires the automatic rolling forward of what appropriations to cover prior year what commitments. Commitment encompasses possible future liabilities based on the current contractual what agreements. So we are saying that whenever the money has not been spent, whenever the appropriation has not been spent, the money has to be sent back to what? Has to send back to the consolidated fund. Where we are saying that in certain jurisdictions, there is a law that is telling those people that, okay, you can keep that particular money or you can take that particular money, don't send it to the next year, carry over to the next year to fulfill whatever commitment that you have made with somebody. You can make a commitment with a supplier to supply 10 bags of cement for you, but you are here to receive the cement, so you are here to pay. That commitment has been made in the previous year before the year end. They can say that keep that amount and be able to pay that particular what commitment in the subsequent year. So in the subsequent year, all right. So the commitment encompasses future this one. In some jurisdictions, they may even refer to as obligations or encumbrances. Okay, I remember the time I was in university, our public sector lecturer will come and chat on these encumbrances. But that time we don't know what he's saying. Okay, and include outstanding purchase orders and contracts where goods or services have not yet been received. So I've explained that already. They can ask you to keep those monies to fulfill those ones. But before you keep those money, Minister of Finance have to give you another warrant, which we call the revote warrants. Okay, so we also have what we call the supplementary appropriations. So that one we have done that one already. So the additional budget that will be submitted to Parliament for approval, because the original budget seems to be insufficient. So our estimate was based on 15% inflation. Now it is 25% inflation. So we cannot actually use or the budget cannot actually help us to fulfill our obligations. So we need additional money. So it's just like 1 month down, we need a backup. How military people will be on the field and be saying that we thought that we are coming to meet 5 people, but at the end of the day, we have met 10 people. So we need a backup. Okay. So hello Alpha, we need backup or something. It's just like the supplementary, or your mom will have given you 10,000 that you go to the market to buy. So if the way you budgeted for the things, you went there and the prices of the items has increased by 5 cedi. So you can say that the money is not enough. You have to call for additional reimbursement. That reimbursement is what we call the supplementary appropriation over here. When you count to the public sector. Okay. What do we call the actual amount? The actual amount is the actual budget that has been implemented. So after the budget has been implemented, what were the actual revenue generated? What were the actual expenditure incurred? That is what we call the actual amount. Okay, the actual amount. And they will be giving you the actual budget together with the original budget or the final budget, and they'll be asking you to evaluate the performance or prepare a budget valuation performance analysis of the district assembly of the government institution. We'll be doing this when we go to the interpretation of the financial statements. Okay. What we are doing is that we are looking at a presentation of a comparison of a budget and actual amounts. What are we saying? So you have to prepare a statement that will be having the budget and also the actual amount, showing any differences over there or whatever will be the case. So entities shall present a comparison of the budget amount for which it is held publicly accountable and actual amount, either as a separate additional financial statement or as an additional budget columns in the financial statement currently presented in accordance with what? With Ipsas. So in the final account, if you're preparing the final account, the question will ask you to prepare a budgeted statement in addition to that one. So the budgeted statement, you prepare it. So you take the figures that you have taken to profit or loss. Those are the what? Those are the actual amounts. So the adjustment that you have done for those figures, those are the actual amounts, and they will give you the budget amount. Okay, you will get the actual amount for all those items. Then you will now get what? The you now get the what? The annual amount, and you actually what? Compare the two, prepare a budget statement. That's what they are saying. That is a presentation of a comparison between the budget and the actual amount. So you prepare a budget statement to show certain variances that is occurring within the what? Within the year. Okay, within that particular year. Okay, so we'll be doing that for final accounts. So sometimes we do that for final accounts. Okay. So presentation and disclosure. An entity shall present a comparison of budget and actual amount as an additional budget columns in the primary financial statement, only when the financial statement and the budget are prepared on comparable what? Basis. On comparable what? Basis. We are doing this for the same period, the same year, and we are doing this for the same accounting what? Policies. What do you call the level of what? Aggregation. Sometimes the budget can be grouped under programs. So the items, so we can have, let's say we can have certain items over there. They are also going to be under, all of them will be under social intervention. So let's say the issue about that Akosobo Dam spillage that is affecting people. That will be the money that the government will be giving to them will be social intervention. Okay. We can also come to the school feeding issues. That's also a social intervention. We can also come to maybe there was a flood in some particular area and people are now doing this, okay? Or there was this attack in certain community, and now some people have lost their life, and the government want to provide shelter, or the government want to give them food. All these things will be a social intervention. So if you're preparing a budget, you can actually group all those items and make it what? A social intervention. You can group them under what? Under a particular heading. So budget document may provide great detail about particular activities, programs, or entities. These details are often aggregated into broad classes under common budget heads, budget classification, or budget headings for presentation to an approval by legislature or other authoritative what? Body. That is what we are calling the what? The level of aggregation. So you can actually put certain expenditure or certain items under a particular heading so that people can actually understand that one. Okay, so this is if you come to, okay, so Ipsas 3, accounting policy, changing accounting policy, along requires financial statement to provide information that meets a number of what? Qualitative characteristics, including the information that is relevant to this one, and that is reliable, and this one. So that is why they are just telling you that it is very important for you to include the budget issues over there. So if you include the budget information, it's going to be giving us a reliable information and a relevant information. We can look at the amount that has been generated and the amount that has been generated. So we can see that this is actually the issue that is coming in over there. Okay. Okay, changes from original budget to functional budget. Entity shall present an explanation of whether changes between the original and functional budget and consequences of reallocation within the budget or of other what? Factors. Okay, so if there's any change in the what? In the original budget, okay, if there's any change in our original budget that has now been given as a final budget, okay, so we have an original budget, that's a budget that has been prepared, okay, but after certain allocation and certain things, we now have the final budget, okay. So if there's any difference between the original budget and the final budget, the entity have to be able to tell whether the changes over there is a result of what? Reallocation. We call something the environment. Okay, we look at the environment. So are we having, although the environment is not going to be having any effect on the total amount, the expenditure will still be the same, but on the individual items, it is going to be different. So if goods and services were 10,000, we have now transferred 10,000 or 5,000 of the goods and services to compensation. It means that goods and services will now be 5,000. The compensation will now be 15,000 or something. But at the end of the day, the expenditure will still be the same. Okay. What is causing that particular difference? What is now causing the difference that compensation for employees is now 15 as different from what the original budget that was 10,000? Okay. We have to take whether it is a reallocation within the budget. Are we doing any reallocation within the budget as a result of environment or whatever be the case? You have to be able to what? You have to be able to tell why that particular thing is coming in over there. Okay, why that particular thing is coming over there. Why that particular item is coming over there. So this one is just basically about the definition and other issues. But this one mostly they can ask you as a theory question where they will ask you to explain, or they can ask you as part of the what? As part of the financial statement analysis. What they will do is that they will just give you a budget statement. They will give you the final budget or the original budget plus the supplements. Then they will give you the actual. Then they will now say you should evaluate the budget performance of what? Of the entity. So you calculate your budget outcome. The budget outcome is just a difference. The difference in what percentage or the budget has increased by how much in relation to the actual amount. What is the difference in the actual and then the final budget? Then you now calculate the differences and explain why that particular differences and how they should investigate that. Now they can also give you the 24 in that particular manner. Okay, or they can also give you as part of the final account where they will be asking you to prepare a budget statement in addition to the statement of financial position and the statement of financial performance. Okay, basically this is about the final budget. Let's pick these 2 tutorial questions, then we look at what we can, then we just end it over here for this evening. Charles, are you there?
Right, sir.
Okay.
So I'm taking question 1. Can I?
Okay. Yeah.
Okay.
Take them.
Question 1. The conceptual framework for general purpose financial reporting provides for inclusion of budget information in the general purpose financial report of public sector entities. Consequently, Ipsas 24 was issued to provide for disclosure of budget information to the general purpose financial reports required. Discuss the benefits of including budget information in the general purpose financial reports. And then M2, explain the following terms used in Ipsas 24. Presentation of budget information in the financial statements. A, approved budget. B, final budget. C, comparable basis. D, multi-year budget. E, appropriation. And F, annual budget.
Okay. Let's look at the first one. What is the benefit of including budget information in the general purpose financial report?
I could talk about performance evaluation.
Okay. What again? I've even mentioned 2 of them before starting this thing.
Fulfilling requirements by the regulations. Yeah.
Okay. So we also do that to ensure compliance. Okay, what again? The budget information will also help us to what? To compare the what? To achieve the purpose of comparability, isn't it?
Right, sir.
Okay. So the three will be okay. Or you can just put them in what? In a statement form and explain. That is all. There's no big deal about that. So you can just read through them. The note disclosure of budgetary entity shall explain in note to the financial statement the budgetary basis and the classification that have been adopted. And this one you just see it in the final account. And if they want to ask you any question, it will be in a theory form like this. Or they can also ask you, discuss the benefits of including budget information in the general purpose financial report. At least you get 3 points to ensure compliance, to also ensure comparability. Then you just explain, and also to measure the performance of that particular entity. So you just throw small light on them and you move on. Let's explain those terms and move on. Okay, what is approved budget?
So I can say, as the name implies, it's that budget that has been approved by Parliament to cater for the current revenue and expenditure transactions.
Okay. Okay. So the approved budget is that particular budget that has been approved by Parliament, which will be implemented. So the budget that has been approved and will be implemented for particular period will be what we call the approved budget. Okay. So what you said is not bad. Let's come to final budget. What do you call the final budget?
So I think that was where I was talking about the issue of adjustments whilst the year is going on, and then you explained that sometimes the adjustments are even done prior to that period. So is that overall original budget that has been adjusted for any reserves or carryovers?
Okay. So is that budget is a budget that has been derived from all that has been derived, taking into consideration the original budget, adjusted against other issues that is necessary. So the final budget is the original budget, which is adjusted against carryover reserves, any supplementary appropriation, and any other issues that will be done. So the budget that will be derived after taking into consideration the necessary adjustments. That is what we call the final budget. Let's come to the comparable basis. What do you mean by comparable basis?
So comparable basis, or was someone talking? Okay,
No,
so the comparable basis is just that way of presenting information by including the budgetary information just for the purposes of comparison.
Okay.
So whether you include the budget information as an additional column in your financial statement, or it's also presented in different statements or whatever, but it should be part for comparability sake.
Okay. So that is not bad. Comparable basis is where you compare your approved budget or the budget that has been implemented with the actual amount, or the budget that has been, or the actual result for the year. So what you do is that you prepare your actual amount or your actual budget on the same basis for the same period as the approved budget, for purpose of identifying variances or whatever we have to do. Let's come to the multi-year budget. What do we call a multi-year budget?
Okay, well, is that budget that has been approved for just more than one year?
Okay.
So like you said,
yeah.
So like you said, when they approve it, it's approved once for the years to come. Just as maybe adjustments may be made from time to time, but the approval for all those years is just a one-time something.
Okay. So the budget that is being approved for more than a year, so it can be approved. It can be a budget that is being prepared for more than a year, but to just be approved for it just be approved in one attempt. Okay, in one meeting or in one debate. Okay, let's come to appropriation. What is appropriation?
Appropriation is the authorization given by Parliament to spend the amounts quoted in the budget.
Okay, annual budget.
So the annual budget is that budget for that whole year.
Okay. So the budget approved for a year is what we call
The annual.
annual budget. All right, that is it. So this one we do it more. Okay, it's they can actually, because the budget preparation in the public sector is a very important area. So that's why I just brought it so that you have an idea about it. But we'll be doing the practical side of it when we are doing final accounts or when we are doing interpretation of the financial statement, where we are going to be using ratio analysis, the common size, and other issues. Okay, so Saturday, let's see, we can do Ipsa. Let's see if we can do Ipsa 5, which is borrowing costs. Let's see, the 31. Okay, the 31 is the same as the 31 is the same as 38, which is intangibles for financial reporting. Financial instrument, they are all the same. Okay, impairment of assets is the same. So I don't know if we can do 5 on Saturday. Okay, then we find time to do the additional one. So we have the Ipsa 31, Ipsa 13. Okay, and we have issues where the government will be leasing assets, and from those people, there can also be an issue of lease. Okay, so we also look at the Ipsa 21 and 26, which is impairment of non-cash generating units and impairment of cash generating units. Then what again? So we have the 29. We even have to look at revenue from exchange transactions. Okay, 9. But those who are doing financial reporting, maybe by now borrowing cost is the same thing, the one that we have done. Okay, the leases is the same thing that we are doing. The impairment of assets is the same thing that we are doing. Okay, the revenue from exchange transaction will be the one that we'll be doing, and revenue from contract with customers. So it will just be a combination of the revenue from exchange transaction, construction contract, and the remaining one. So 1, 2, 5, 1, 2, 3, 4, 5. Let's see, that will be 6. But let's say we can actually do maybe 2 of them. Then the remaining one we just set out a DOM meeting and look at some of them. But next month we're supposed to start the ratio analysis and then the final account. If you're able to do them early, then we can come back to some of the standards again. But we find time to complete the standards during dawn. We have to complete at least most of them, because we don't know which one will come. Okay, we don't know which one will come. So we just have to complete most of them, solve some questions on them, and see what we can do. So that is it. For the business combinations, it's the same as the financial reporting one, the console. Public sector, we also have console there. Public sector a government can acquire another NGO, okay, where the government will be having majority of the shareholding. The government have to prepare a consolidated financial statement. So that's also the same as the one that we have in financial reporting. But those ones, it's not likely that they will start asking those ones now. So we can actually leave those one. Investment in associates, business combinations, consolidated financial statements, we can actually leave those ones. Employees benefits, we can actually leave those ones, although they can also examine where the government will be giving, like the pension benefits and all those things are part of the employees benefits. But we just see what we can do for now. It's only 3 months. It's not even up to 3 months, but we cannot focus on the standards and leave the ratio and then the final account, which are 2020 maximum. So we have to start looking at those ones also. So for next month, we start a ratio. Maybe the ratio, we look at it, try to do it in a very simplified way. Then we move on to the final accounts, try to do that one in a very simplified way. Then maybe we'll be doing the remaining standards are done. Okay, if the time comes, you should be able to wake up so that we can all participate towards achieving success together. All right. Any questions, Ines? Any question?
Yeah, good.
So
Okay, so good night. I'll see you guys. All right.